There's been a step up in concern about the consumer.
There's probably a little bit more downside risk in the economy than the markets may appreciate.
Good situation here. Things are indeed getting better.
There's enough good going on to offset whatever the weakness is.
Overall, the consumer is hanging in there. That's why the economy is going to continue to expand.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with your equity market shaping up as follows on the S&P 500. Equity futures just about unchanged after snapping the longest winning streak of the year so far on the S&P. Once again this morning, chipping away at recent gains on the Nasdaq 100, lower by 0.1%. Things are quiet at the moment. They pick up a little bit later. Your day ahead looks like this. We get some earnings from the likes of Target and TJ Maxx. You get a sprinkle of politics, some Fed minutes this afternoon. But at 10 a.m. Eastern time, that might be the main event for financial markets. Lisa, a revision to a year's worth of non-farm payrolls.
The expectation is it could be anywhere from a revision downward of about 360,000 jobs to potentially 1 million jobs that would be taken off the year ended in March for this year. Here's the key question. Do we end up with a downward revision that essentially is the biggest in 15 years, which is any downward revision that exceeds 500,000? This, to me, just gives you a sense of, wow, could we see another narrative shift if this really does surprise in the wrong kind of way?
What strikes me as absolutely mental, like seriously mental. Listen to this range from the likes of Goldman Sachs, so a group of really fantastic economists led by Jan Hatzius. A range of anywhere between a revision of 600,000 to 1 million lower. That's anywhere from 50 to 85K per month. So we're sort of setting the tone for Jackson Hole and Chairman Powell's address this Friday in a rather peculiar way.
So this really goes to the perilousness of being so data dependent on data that has proven to be time and time again, not unreliable, but fudged. At least when you look at it in the past view, the rear view mirror. Here's the issue. This is the preliminary revision. We get the final revision at the beginning of next year. And what they're basically doing is taking the quarterly census of payrolls and pairing it with some of the other data that they collect. There have been issues with survey responses. The issue is that this will really color how much momentum there is in the labor market at a time when we already are seeing cooling. Does this cast another shade on that non-farm payrolls report that was disappointing last week?
This is a really important discussion, and I often reflect on some of the words from Chairman Powell from back at the start of July in Sintra, Portugal, at the ECB get-together, when he said, because the economy is strong and the labour market is strong, we have the ability to take our time to get this right. So how strong is this labour market and how much time do they actually have?
Does this change the conversation in terms of the balance of risks? We already saw yesterday, albeit a quiet day without a real obvious catalyst, the chance of a 50 basis point rate cut increasing. And if you look at Fed funds futures, so people looking at the odds that maybe he could come out and talk about the need to get ahead of any kind of downturn. Key question is, how do we have a good gauge of an economy that already the Fed kind of got wrong due to some of this data that got revised to the upside back a couple of years ago in the post-pandemic fog? Is this going to be a similar kind of revision, although in the opposite direction, that really flavors the conversation in a different kind of way?
That data drops in about 4 hours' time, so look out for that. As for the earnings, Target at about 6:30 Eastern. We'll break those numbers for you in about 27 minutes' time. For the broader market, equity futures on the S&P 500 just about unchanged. In the bond market, on various points along the curve, we are near the lows of the year on a closing basis. On a 10-year right now, 381.42. Yields up by almost a single basis point. Things a little bit calmer in the FX market here, Lisa. Euro dollar in and around 111.
This is a quiet period, right? This is sort of the more typical dog days of summer. That said, it is important to reflect on where we've come from. I love this quote by Bespoke Investments that markets usually take the stairs up and the elevator down. But in this case, it took the elevator both ways. You saw some of the biggest swings from oversold to extreme overbought to then overbought going back to World War II. So a little bit of calm, kind of welcome on a day like today.
Just a little bit of calm. And on that calm morning, this is the lineup for you. And I'll go through it rather calmly for you. Andrew Sheets of Morgan Stanley on risk to his soft landing view. Anne-Marie with the latest from the DNC in Chicago. And Torsten Slok of Apollo on some big revisions to US jobs data. We begin with our top story. Stocks holding steady ahead of those revisions at 10 a.m. Eastern Time. Andrew Sheets of Morgan Stanley writes in the following. The Fed chose to remain on hold in July despite less inflation, despite rising unemployment. Policy works with a lag. Once the Fed is behind, it often struggles to catch up. Solid data, not dovish Fed speak, are what's most important now. Andrew joins us now for more. So, Andrew, let's get straight into it. Despite those comments from you, you say keep the faith. Keep the faith in corporate credit and maybe keep the faith in that soft landing too. Andrew, why should we keep the faith?
Yeah, thanks. Good morning. It's great to be here with you. So look, I think this is a market where the growth data is now in the driver's seat, where I think the market is rightfully focused on the importance of growth holding up. And if the Fed is late, if policy is too restrictive, then rate cuts might arrive too late to do anything about that. But our expectation is that the growth data will hold up, that we will see a soft landing, that the consumer is strong enough to support this expansion continuing. And I think that sort of moderate growth, moderating inflation, moderating policy rate that we expect at Morgan Stanley is a pretty good backdrop still for corporate credit.
How important are those revisions that drop at 10 a.m. Eastern Time, Andrew? When we talk about how strong the labour market is, do we really know how strong the labour market is?
Yeah, so I actually thought your lineup today is a really great sign of what the market's focused on. We have retailer earnings, the state of the consumer, incredibly important for where the economy is. The labor market revisions, where the job market is very important, especially. And Lisa, to your point that you mentioned earlier, the Fed is very focused on the labor market, but the labor market tends to be a lagging indicator. So, you do have this environment where if the labor market starts to show weakness, history would say that that's almost already too late. So the labor market's very important. And then we have the Fed minutes. And so how is the Fed thinking about all this? And is there more insight to how restrictive they really think policy is? But yes, I think the growth data is at the center of this discussion. And I think the labor market data, the weekly jobless claims numbers that we're going to be getting, the next non-farm number, these are all going to be really important.
What would you have to see, Andrew, today in the revisions for payrolls, or the initial revisions, that would make you rethink the likelihood of a soft landing?
Yeah, so I think something that would be significantly different than expected. I also do think that this is an area where I think the market will look at a variety of data. And so, it's not just today's number, but it's going to be Thursday's jobless claims number. It's going to be the next non-farm number that's important. And, I think it's also about how much, we see from some of these other measures, some of these survey measures like ISM, like the index of leading economic indicators, a number of things which have been genuinely mixed. So, today's, revisions are notable, but I think the market's going to also be focused on a variety of metrics and certainly some of the upcoming more kind of real-time measures as well.
Andrew, I got to say, I read a lot of notes last night, and I was struck by the tone in all of them, where the downside risks to the U.S. economy seem to be growing. That is something that I saw again and again, and that people have increased conviction in going into risk assets because the Fed is going to respond. It seems like these two ideas are a bit contradictory. Can you explain why they're not?
So actually, I think they are contradictory. I think that if your a mindset is the data is going to weaken significantly, but it's okay because the Fed is going to cut and potentially cut aggressively, I think you're actually fighting quite a bit of history with that. I think historically when we've seen weaker data and more rate cuts, more aggressive rate cuts, that's been a bad outcome for risk assets. That's been a bad outcome for credit. Kind of the more the Fed's been cutting, the worse it is, because that often represents significantly weaker economic outcomes, and the benefits from those lower rates don't arrive in time. Policy works with a lag. So I would say our constructive view is kind of the other way around, is based on the view that we think the data will hold up. The Fed will cut modestly. The Fed will cut steadily and slowly, and that will be a combination that's consistent with a soft landing. But I think in a scenario where the data is weaker than expected and the Fed is cutting more, I think the market will be weaker than we expect.
So, Andrew, if I were to close this interview now, say thank you as always, it's great to catch up and walk away, the first thing I'd say to Lisa is, I think he's probably long consumer cyclicals in credit here. Andrew, are you long consumer cyclicals in credit?
So I think the challenge in credit is we don't necessarily see a great deal of risk premium in the cyclical parts of the credit markets. We tend to like the financials a little bit more. That's a cyclical sector that we think there is still some risk premium. I would say within the retail sector, our sector credit analysts will highlight you see quite a bit of dispersion there. You actually have seen some quite good earnings reports from some of the retailers in the second quarter and some weak ones. So I think it's a sector where we're more focused on kind of the relative value. Overall, the risk premiums don't seem particularly notable.
There's a larger issue here, too, which is whether the U.S. is just more generally overpriced at this point if you're looking at some sort of recovery or some sort of Fed that could intervene in a correct time. Not to go too far off the beaten path, but I was looking at your notes and seeing that you like Chinese credit, which just sort of highlights sort of a search for yield at a moment where you see U.S. companies moving out of China and an increasing aversion to just geopolitical risk. How do you justify this idea that this is a fraught moment with a real question mark around the Fed's response function, and yet it is a good time to go risk on into areas that are some of the least loved?
Yeah, so I think China investment grade is kind of an interesting dynamic where we think kind of weaker growth, weaker inflation is working in the favor of the bondholder. So, I think whereas the focus in a lot of other regions has been inflation might be too high or too sticky, I think China is the economy where there's the greatest risk that inflation is too low. Not just this year, but kind of in future years. There's a higher risk of a deflationary sort of risk scenario. And that sort of scenario can actually be quite good for total returns for bonds, especially long-term bonds. Companies in that scenario are not releveraging, they're deleveraging, the economy is deleveraging, yields are falling, policy rates are staying low. So, we think in that environment you see both kind of total return benefits from a low yield environment and lower yields boosting the returns for China investment grade bonds, and also an environment where those lower onshore borrowing rates from banks as rates stay low or even go lower kind of incentivize companies to borrow domestically rather than financing in the dollar bond market. And that can be good for keeping supply low and, again, kind of supporting the bond market there.
Andrew, you are one of the best, sir. Appreciate it. Thank you. Andrew Sheets there of Morgan Stanley out of London this morning on corporate credit. Two-part story there. The tone of the story, the price of the story. When you hear the tone of the story, it's a good story to tell. When you start to ask about the price of the story, there's parts of consumer credit that are still pretty rich out there.
When you start to take a look at spreads and you take a look at yields on high yield bonds, which are the lowest going back several years, you start to wonder, are we priced to perfection at a time where there still are those downside risks and there is a lag ostensibly for Fed policy to work? So it sounds good, but the question of whether you get in is fuzzier, which is the reason why I say there's sort of this dissonance right now where the downside risks are there and growing, but people are banking on the Fed rate cuts in a way that they never have before and are hoping that the Fed can do it in time.
More on those consumer-facing companies a little bit later this morning. Again, Target earnings dropping in about 18 minutes' time, so look out for that. Equity futures on the S&P, no drama here whatsoever, just about positive on the session. Let's take the opportunity to get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A third day of search and rescue efforts is underway around a sunken yacht near Sicily, Italy. Passengers British tech entrepreneur Mike Lynch and Morgan Stanley International Chairman Jonathan Bloomer are feared dead. Lynch, Bloomer, and 4 others are still missing after the yacht was hit by a type of overwater tornado on Sunday. Crews aided by military ships and helicopters have been searching since Monday. 6 guests, including Lynch's wife, and 9 crew members have been rescued. 1 person has been confirmed dead. Sephora is cutting hundreds of staff in China. It's attempting to turn around a loss-making operation in the world's second largest economy. The LVMH-owned cosmetics giant has fired both office and store staff and has persuaded others to resign. Sources told us that an estimated 10% of more than 4,000 employees in China will be let go. A Sephora spokesperson saying the brand is streamlining and its structure in order to bolster long-term growth capability. Barack and Michelle Obama fired up Democrats in addresses that capped the second night of the DNC in Chicago. They criticized Donald Trump and pointed to Kamala Harris as the heir of their historical political legacy.
We do not need 4 more years of bluster and bumbling and chaos. We have seen that movie before, and we all know that the sequel is usually worse. America's ready for a new chapter. America's ready for a better story. We are ready for a president Kamala Harris.
The former Democratic president also drew parallels between his historic run and Harris's rise to the top, but warned of a tough race ahead. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, contrasting visions for the United States.
I like to say the Republican Party is now the party of common sense.
This is not just about us versus Donald Trump. This is about two very different visions for our nation.
The latest from the DNC in Chicago with Anne-Marie up next on the programme, live from New York City this morning. Good morning. Live from New York City, welcome to the programme. Your scores look like this on the S&P 500, very small. Mild losses in yesterday's session, very small mild gains in this morning's session. So far, the S&P up by not even 0.1%. Under surveillance this morning, contrasting visions for the United States.
I like to say the Republican Party is now the party of common sense. Conservative, yeah, I guess conservative, it doesn't matter. It's the party of common sense.
This campaign is not just about us versus Donald Trump. This is not just about us versus Donald Trump. This is about two very different visions for our nation.
So here's the latest. The DNC continuing today with Vice Presidential pick Tim Walz set to speak tonight as Donald Trump continues his counter-programming campaign, holding a rally on national security in North Carolina. Anne-Marie joins us now from the DNC in Chicago. Good morning, Anne-Marie.
Good morning, John. You can see the swing states are really in play right now as we were just a few months out from November 5th. Last night, after the roll call at the DNC, which was filled with a tremendous amount of energy and also some cameos like Little John showing up for Georgia, Kamala Harris was about 90 miles north from where I'm sitting now in Wisconsin, in Milwaukee, a state that is a must-win for the Democrats, part of the blue wall. And Milwaukee, so interesting at Pfizer Center, where Donald Trump just a month ago was giving his acceptance speech. And then, of course, today you have Donald Trump on the campaign trail, notably in North Carolina. Just yesterday, Center for Politics, Kyle Kondik, put North Carolina in the lean Republican camp to now a toss-up. This is so important because we heard from President Barack Obama last night here in Chicago. He was the last Democrat to win that state in 2008. Prior to that, it hadn't gone for a Democrat candidate since 1976, and now is it considered a toss-up. So you can see how tight this race is. But what really stood out to me yesterday, whether Kamala Harris saying this in Milwaukee or Barack Obama talking about this at the end of his speech, they said, do not give up this moment. The torch has been passed, said Obama, but now it's up to all of us to fight for America we believe in, and make no mistake, it will be a fight. They're trying to say, despite all this energy, he talked about despite all this excitement and the memes that are coming out, this is a toss-up election, and that's very clear today and last night, depending on where you see both these candidates.
Something uniquely American about Kid Rock versus Little John. Don't you agree? Bramo?
I guess.
You're not going to see that anywhere else, are you?
Why is it, though? I'm serious that we have this sort of comparison of celebrity music stars in all of these events.
I don't like it either.
Okay.
I really don't like it either. AMH, thank you. Thanks for the update. We'll catch up with Anne-Marie a little bit later this morning. Terry Haines of Pangaea Policy has the following to say. Trump is trying to move issues and get more disciplined this week. That's a good thing. But Trump is still not coordinated and focused. Trump is just speaking to the already converted when he should be trying to broaden his appeal. Terry joins us now for more. Terry, we've got the DNC, that's ongoing. I think we're all focused on September 10th, circled on the calendar. That debate, the face-off between the two candidates. What is that debate going to be like from your perspective?
I think what you're going to see, John, is a battle of message focus. So Trump will be counseled again and again and again to focus message on Harris's record, the Biden-Harris administration's record, and frankly, I think you're going to hear and see a lot about what's gone on in San Francisco and other cities in the last few years. You're also going to hear about Walz and Minnesota and Minneapolis in 2020. They will, and they'll make an economic pitch. Harris is going to be all about the future, all about what's next, and you'll hear that one great word that comes out of Democratic conventions: hope and change. And she's going to be the hope and change candidate. I think it's already clear from this convention. But she'll stick to message very hard. So Trump can't wander.
You talk about how it's hope and dreams in the future. You also call it spaghetti politics, that basically you've got things being thrown at the wall in terms of policies that will not be made into law. And you start talking about what do we actually know about her framework going forward, about her economic policies, et cetera. Is there anything that we have learned, other than a lot of these policies are not going to see the light of day? Is there anything that we've learned about the difference between Kamala Harris in 2024 versus Kamala Harris in 2020?
I said on your program a while ago, and I'll say it again. Harris is a shapeshifter, and I don't think that's a bad thing. I think that's a good thing in a politician generally, because you're adapting to circumstances. Her at the top of the ticket this time out, leading a party, is not about personal preference. It's about leading that party and moving forward, and then attracting people who might not be, fully in your party, but are sympathetic to your ideas. That's really what she's trying to do right now. That's a very different Kamala Harris than trying to attract primary voters in 2019 and 2020. So, I don't expect that she's going to be the same. I don't expect, consistency in her view. They're very different perches.
I expect it to be consistent over about a week, though, Terry, and policy seems to be shifting from day to day. It was price gouging leaked to the press last week, and then it was kind of, but not really. What are the key policy initiatives coming out of the campaign?
I think by and large what they're going to do is, judging by what Harris says and what's in the Democratic platform, which is not hugely important, but it matters in terms of how the rank and file think about these things. You're going to see a continuation of Biden policies by and large, which include greater government investment, and they hope greater government taxation at root. But what that means in large part is you're not going to see any attention to getting fiscal under control or getting debt and deficit under control, and that seems to be the primary preoccupation of markets when you look at what comes out of Washington.
We've talked a lot, Terry, about how this is all about vibes and good feelings, and then we saw that with the RNC, and now this is the DNC. What strikes me is that this ultimately is a party that is being unified by the anti-Trump rhetoric, by basically running against Trump, not Trump again. How far do you see that getting this election, this campaign, given the fact that at some point people may look beyond that?
Well, unifying your party is job one, and Harris is doing that. One of my critiques about the Trump campaign is I think Trump is not doing that. Trump is unifying his base, which is not the party, and is not making effective outreach to consolidate that party support, and not reaching out to independents effectively, I think. So Harris is doing what she needs to do this week, but going forward, it's very clear that what they're going to lean on is concern about social issues plus fear of Trump as the motivating principles.
Terry, thanks for your input this morning. Thank you, sir. Terry Haines there of Pangaea Policy on the latest on the campaign trail for both the Democrats and the Republicans. Can we pull up the price of gold just briefly? Pulling back from all-time highs, but still around 2,500. Stat of the week. I think stat of the week comes from Jack Whittles over at Bloomberg, or rather here at Bloomberg. The milestone that we reached on Friday, when we crossed 2,500 per troy ounce, an all-time high. Gold bars typically weigh about 400 ounces. That would make each one worth more than $1 million. Have you ever held a gold bar?
They're incredibly heavy.
Super, super heavy. $1 million a gold bar now.
So I've heard this, and I have to confess I haven't been to one of the vaults at the bottom of a bank. If anyone wants to give me a tour, would love that. But evidently people wear steel-tipped shoes, because if they drop those bars, they will break their toes. That is how heavy these bars are. And now they're heavy in terms of a monetary sense as well. The why is what I find interesting. Is this because of the deficit, or the deficit is going into gold? Or is it because of central bank buying or something else that's going on?
Lots of reasons. At the Austrian Central Bank, if you ever find yourself in Vienna and you can go into the Austrian Central Bank, there's a game that you can play. You put your hands through and you try and lift the gold bar, and and pull it out, which of course you can't do. I've no idea if it's still there, given that it's now worth $1 million, and when I was last there, it wasn't.
Can you keep the gold bar if you're able to
It's just
pick
impossible.
It up?
It just doesn't fit.
Yeah.
It just doesn't come out.
What if you're just amazing?
Like a magician.
Yeah.
Then
good luck.
Good luck.
Okay, we'll check it out.
In just a moment, we'll get numbers from Target, or as Target, as TK liked to call it back in the day, Target.
It wants to be Target now because Target sounds high-end, and they don't want to be high-end because evidently not being high-end is probably the way to go.
That's smart. Things have changed. It's Target.
It's Target.
Again. And those numbers drop in just a moment. So Lisa's going to break them when they drop across the screen. Let's start with the price action elsewhere. The scores on the S&P 500, just about positive by almost 0.1%. On the NASDAQ, we're just about unchanged. On the Russell, we're positive by 1/3 of 1%. As Target drops, I'll just bring you some yields in the bond market on a 2-year, 10-year and 30-year. If we switch at the board, we look a little something like this. The 2-year yield higher by almost a basis point, 3.99. Lisa, what have we got?
Well, it looks like Target is following a similar type of story as Walmart. Comp sales in the second quarter up 2%, or almost double the estimated 1.07%. The full year adjusted earnings per share forecast is from $9 to $9.70. It saw previously $8.60 to $9.60. The estimate was $9.22. You could see the shares popping in pre-market trading. What I find interesting here is essentially people who said that Walmart's gain was everybody else's pain are not seeing that trickle through in Target, which always has been number 2 when it comes to this company. Looking at revenue rising, comparable sales rising, talking about how you are seeing margins that are continuing to expand. So we'll keep digging through all of these numbers. What it highlights to us is that, frankly, it is not an anomaly that Walmart did well, that the consumer can still spend, and even if they're looking for value, they are still using their hordes of cash to keep deploying.
The takeaway pretty straightforward this morning. The stock is up in the pre-market by close to 10%. That's the knee-jerk reaction to these results. Higher traffic in stores, rising online sales. The line coming from the CEO, we made a commitment to get back to growth. Our team delivered. We're staying on offense. Lisa, we heard this from Andrew Sheets of Morgan Stanley about 30 minutes ago. What's happening with consumer cyclicals, what's happening with staples, and what's happening within retail? Some companies seem to be doing a much better job of executing than others.
This is the CEO in another comment saying, I think we see an incredibly resilient consumer in the face of high inflation and some of the other challenges that have been facing to manage their household budget. These are executives that want to seem sensitive to the average plight, and yet they are seeing consumers that are willing to spend. Basically, does raise a question to your specific point about whether to go into consumer cyclicals. Are we seeing the beginning of some sort of recovery cycle that will be fueled by a Federal Reserve dropping rates? Or are we seeing something that's already been priced in fully at a time when potentially we haven't fully seen the lags?
Well, let's go through the different retailers. So Walmart, decent, Target, good. Based on these numbers and the price action this morning, OK. Let's move on to Home Depot and Lowe's over the last week, both cutting their outlooks. Home improvement's a real struggle. If you go to the food industry, let's go to fast casual restaurants. Let's go to fast food, Lisa, more broadly. There is a promotion every single day, everywhere you look, when it comes to those businesses. So different companies experiencing a very different consumer at exactly the same time.
At a time when people are looking for value and they're trying to get it in a lot of different ways. Some people will read into that because the consumer is strapped and they don't have that much money to spend. Other people could look at it as, for the first time, you're seeing real consumer pushback to inflation that had been running at the fastest pace in decades. And suddenly this sort of speaks to disinflation with a consumer that's willing to push back and do what a lot of people wanted them to do, say, a year ago. If the labor market doesn't fall out, this is actually a very healthy recipe for disinflation and ongoing growth.
Get that stock on the screen. We're up by 10% in the pre-market on Target as that company and those earnings, sales swing to growth. Much more on that story a little bit later. Of course, we get numbers later this morning from TJ Maxx. We'll hear from Macy's as well. All of that coming up throughout this morning. Target up by more than 10%. Elsewhere, I want to turn to this story. Day 3 of the DNC getting underway in Chicago. Vice presidential pick Tim Walz is the headline act scheduled to speak tonight. Donald Trump continues his counter-programming tour with a rally in North Carolina. And on a program like this, we're laser focused on what is and what isn't happening with economic policy. Last week, it sounded like a really aggressive push to really clamp down on price gouging, whatever that is and wherever it might be. They seem to have backed away The campaign seemed to have backed away from that big time. If you missed our interview with Mike Parr, the economic advisor to Kamala Harris yesterday, I suggest you go and have a look at that conversation, because that conversation did not sound like some of the conversations we heard last week.
Building on prior legislation, existing legislation to deal with emergency situations where there could be specific companies that are bad actors is very different than saying we're going to go after companies for raising prices too much on a broader sense. Look, a lot of people saying that this is not really going to stick. That's the reason why we heard from Terry Haines, spaghetti politics. It's sort of to give a sense of empathy, a sense of understanding the plight of people who are grappling with faster inflation. That said, it really does leave a blank slate as far as what policies are actually going to put into effect, whether it's Kamala Harris or Donald Trump, considering that Donald Trump 2.0 may be somewhat different from Donald Trump 1.0.
It's pretty confusing, isn't it, when it comes to both candidates right now, the kind of policies they kind of want to introduce. When you listen to the campaign, the Harris campaign in the last week, big push to clamp down on price gouging, maybe even price controls, big fear about the outcomes of those kind of policies, then backing away from that on the campaign in the last 24 hours, the last 48 hours. When it comes to home building, there seems to be something concrete there. They want to incentivize home building. At the same time, they want to address the inability to buy in America by helping people with down payments. And we talked about what would happen to prices. I think all roads lead to the Federal Reserve and a lack of inventory when it comes to affordability in America. We'll be talking about this with a home building analyst a little bit later this morning at about 8:15 Eastern Time. We'll catch up with UBS. You've got to think about the difference between the effective mortgage rate right now and the market rate right now. The effective mortgage rate in America, so the average rate on outstanding mortgages is running at about 4%. Right? 4%. The market rate, a little south of 7%. That's a big spread. And that's why we've got this massive lock-in effect. The leases of this world that will not put their house on the market because they do not want to leave these mortgages behind. But
why?
You're not alone. There are so many people in that seat. So when we talk about affordability in America, a lack of inventory, really we're talking about the Federal Reserve, aren't we?
Well, that's the reason why we heard from Neil Duddy yesterday that he's looking at something like a 5.5% mortgage rate, effective mortgage rate, to actually get some of that volume into the market. You talked about this yesterday, and it's a really important point. Yes, this is a supply issue. It is not a demand issue. It is not the inability of people to spend that much more. That's not alone going to bring down prices. If anything, if you give them more money, it will increase the prices and make things even less affordable because of a lack of a supply. If you take a step back, Toll Brothers reported earnings yesterday after the bell. Solid demand for luxury housing. This really is a sort of really key question with the divide of who can buy homes and which homes are available for.
I think a lot of people frequenting Toll Brothers maybe not borrowing, right? Cash buyers.
Right. So it's a very different clientele, but it just highlights, I don't know. It's an interesting moment, and it's one that has to do with policy for the builders. If you start to juice the other side of things, it could have a distortive effect.
We'll try and get some numbers on that for you a little bit later this morning. I'm still looking at shares of Target. The stock's still climbing in the pre-market. It's up by 12% now, Lisa, in early trading.
What I find interesting is that shoppers spent more on non-food items, including apparel. We saw this also with Walmart. This isn't just people going to buy staples. This is other, to Andrew Sheets' point, consumer discretionary items. This really does speak of people who have money to spend. Target shares finally turning around after a lot of pretty bleak quarters, up 13%. This doesn't scream of an economy that's rolling over, that's increasingly on the brink of recession.
Big bounce for that stock early this morning. More on that a little bit later, up by 12.2% in early trading. Let's turn to the latest in the Middle East. Hamas saying it's keen to reach a ceasefire agreement with Israel, adding comments from President Biden and Secretary of State Antony Blinken were misleading. Blinken earlier saying Israel had accepted a proposal for a pause in fighting, and the next step is for Hamas to say yes. Julie Norman of University College London joins us now for more. So, Julie, what's your sense of things? Where do things stand, and who's holding up this deal?
Yeah, well, good morning, John. You know, right now, I would say it doesn't look very promising at the moment. The best news we can say is that the actors are not fully walking away from the deal. We heard, as you noted, Hamas saying they are still in this. In fact, they are not trying to hold it up. But the likelihood of a deal coming through soon is unlikely. What's seemed to be the holdup this week is some new conditions essentially really being pushed by Netanyahu that Hamas claims have just shifted the deal to a point where he essentially knows they can't accept it. So this isn't to say the talks are over. They plan to continue, but I don't see anything coming about this week.
Julie, you've been watching this space for a very long time. If you take a step back, would you say that Bibi Netanyahu right now is the biggest holdup?
I would say that right now, some of the conditions that he has imposed since we were very close back in July have certainly kicked this further down the road. And we're hearing that from some of Netanyahu's own colleagues, some of the Israeli negotiators themselves, saying it's been very difficult for them to negotiate effectively because of some of the hard lines Netanyahu has imposed on them. So I think if you're hearing it from those individuals themselves, that is certainly quite telling. Of course, there's been a lot of back and forth throughout these negotiations. And we have to remember, events have been continuing throughout as well. There has still been strikes in Gaza. There was a suicide bombing attempt in Tel Aviv this week. Bodies were recovered from some of the hostages. So conditions on the ground are shifting very quickly for both communities also.
There's a larger question that we really haven't gotten a clear answer on, and it might not be possible to get one, which is how much could some sort of ceasefire agreement stave off this sort of specter of an Iranian retaliation? Is this something that can be de-escalated with an agreement, even if it is tentative? What's your take on that?
Yeah, well, one of the reasons that a ceasefire is so important, obviously we focus mostly on Gazan civilians, on Israeli hostages and their families. But a ceasefire means so much more for the region right now. It is really the key linchpin for preventing further escalation on the northern border with Lebanon and Hezbollah, which has been escalating quite rapidly. It's very important for staving off this potential retaliation from Iran, though that seems to be slightly delayed as it is, and as well as from continuing operations from Yemen, from Houthis in Yemen against shipping, which has cost over $1 trillion to the world in shipping costs. And so I would say there are so many other things going on in the region that are linked so much to this ceasefire. And I would point out, too, all of these elements also include the U.S. A broader regional escalation will draw in the U.S., whether Harris, Trump, any future president wants it or not.
Julie, we caught up with Amos Hochstein earlier this week, advisor to the President of the United States, and he certainly gave us the impression that there was a big opportunity to strike a deal here, an opportunity that maybe didn't exist in previous rounds of talks. And Julie, what we were trying to figure out was whether that assessment was shaped by facts on the ground or just informed by the political calendar. It was something they were wishing for, given there was an election coming up in November in this country. Julie, do you think it's informed by the facts on the ground or shaped by the political calendar?
I would say it's a bit of both. There's definitely been some wishful thinking, I think, from Washington with the clock ticking down and knowing this is the real last moment for them to lean in their shoulder. With that said, again, everyone knows that this moment is extremely tense. Again, this risk of a Iranian and or a Hezbollah retaliation did seem to put the pressure on for some kind of ceasefire deal. At the same time, again, the operations in Gaza have really put the pressure on Hamas. So in terms of there being a need for this right now, that is quite ripe, and yet we see it very difficult getting it over the line. I think right now the best we can hope for is another pause, some kind of at least first phase of this wider deal that's been talked about, but the broader deal itself still seems quite a way off.
Julie, appreciate your perspective, as always. Thank you. Julie Norman there of UCL on the latest in the Middle East, the latest on Target. The stock is still climbing. Let's get you an update on that and more with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John, that's right. Target is surging up some 14.4% in the pre-market trade. It ended a string of sales decline in the second quarter, and it cited improved discretionary spending. The retailer also said that comparable sales rose 2% in the quarter. That is higher than the average estimate of analysts, while breaking 4 straight quarters of contraction. Earnings per share also beat expectations. It is the first sign of a turnaround at Target after higher inflation and interest rates prompted consumers to pull back from big purchases and spend less on discretionary products. China has launched an anti-subsidy investigation into dairy imports from the EU. It's just the latest in a tit-for-tat trade dispute. This probe, though, targets several dairy products, include fresh and processed cheese, according to China's Ministry of Commerce. It will also review 20 of the bloc's subsidy programs. Europe expanded tariffs on Chinese-made EVs, saying yesterday it plans to introduce a 9% tariff on Teslas imported from China. Now, relatedly, Xiaomi reported its fastest pace of revenue growth since 2021. The Beijing company has seen initial success with its first electric vehicles, putting it in direct competition with the likes of Tesla and BYD in China. Now, speculation is growing that Xiaomi has its sights on the European market. They showcased one of its electric sedans during the Paris Olympics, despite the EU's tariffs. Xiaomi also reported a recovery in its smartphone business. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, running the risk of falling behind the curve.
For the Fed, If all you're going to do is string out a bunch of 25 basis point rate cuts, I mean, it could take a long time to get to neutral. And the further the Fed is away from neutral, the more the risk to the economy.
A preview of some big revisions to US jobs data up next. You're watching Bloomberg TV. Check out shares of Target. That stock is up in the pre-market by close to 15%. We're up by 14.5. Target ending a string of sales declines. Pretty flat, that stock price on the year so far. Elisa, it's not flat anymore.
Yeah, it's basically up about 1% on the year versus a 17% gain on the S&P 500. Well, we just basically brought it up to speed with the rest of the S&P just based on pre-market trading. They did cut prices on some of their grocery goods, which is part of what they are saying lured people into the stores. But what I find interesting is what people spent money on. It was the non-food items. It was apparel. It was the things that they were not spending on when they were supposedly more concerned about some of the inflationary risk. Again, this and Walmart together, not speaking of a consumer running out of steam.
Not at all. That's the latest from Target, the latest from TJ Maxx, and the latest from Macy's, all coming out throughout this morning and today. Under surveillance this morning, running the risk of falling behind the curve.
If all you're going to do is string out a bunch of 25 basis point rate cuts, I mean, it could take a long time to get to neutral. And the further the Fed is away from neutral, I mean, they're very restrictive by their own admission, the more the risk to the economy, given the fact that they're very far from neutral and the fact that the data on net has been somewhat weaker than expected. I do think that kind of supports larger moves at the outset.
Here's the latest. Payrolls revisions from the Bureau of Labor Statistics due at 10 a.m. Eastern Time. Economists expecting the data to show U.S. job growth for the year through March was much weaker than estimated. Torsten Slok of Apollo shaking off the weakness and focusing on the strength. Daily and weekly data shows that retail sales are strong, jobless claims are falling, restaurant bookings are strong, and air travel is strong. The bottom line is that there are no signs of a recession in the incoming data. Torsten joins us now for more. Torsten, good morning to you, sir.
Morning.
Let's start with these revisions that come in a few hours' time, and I'll share the estimates that come from Goldman, and the range is this wide. OK, it's anywhere from something like 300,000, 600,000 or a million. Anywhere from 50 to 85,000 per month. What do you make of these numbers? JP Morgan 300 and something, Goldman 600 to a million, revised a little bit later this morning.
I think this is important for the economist, and this is important also for the Fed, but it really is not important for markets. This is looking back in history and trying to figure out how much did employment grow, and if employment grew a little bit less, then yes, of course, overall that does send a little bit different signal about where we are in the business cycle, but broadly speaking, I don't think this will get much weight in financial markets.
What do you think is normal? What's the normal run rate now for jobs growth? Is it the 114 of the previous month?
Well, so there was a very important paper by Tara Watson and Wendy Edelberg from Brookings, or the institute that produced some estimates that says that we will probably have employment growth for the near term at around 200,000, a little bit below. So if that's the case, because of immigration playing such a big role, we should also see a boost to non-farm payrolls. But that's probably going to over time fade, so we'll probably get down to the long run estimate, which we would estimate to be around 100,000.
It begs the question why we took last month so seriously if you don't think we should take the revisions that seriously.
Well, but that's also why jobless claims for the last few weeks have been signaling that everything is just fine. If you also look at a broad range of other indicators, as we just ran through, both with travel, with restaurant bookings, hotel bookings, also look broadly speaking at how many companies go into default. There's weekly data also for that. We also have a general picture that the economy is just not slowing down. This whole narrative, as you just spoke about with Target, Walmart, TJ Maxx, this whole narrative that we are slowing down is just not evident in the data. So that's why I think that we should in markets think about the outlook for the Fed with that backdrop.
You've said in the past, over the past few months, that you didn't think that any rate cuts were necessary. This comes at a time, at least not this year, this comes at a time we've got 100 basis points of rate cuts being baked into the market. And you're saying that it's most likely that the Fed is going to go next month. What do you think the consequence will be of a Fed that starts cutting next month at a time when you still, sounds like, don't think it's necessary?
Well, that's why, as Neil Dodder was just saying, there is this whole concept that we are way too restrictive. But that is only if you have our star or where the Fed is going at a much lower level, maybe I say 2.5 or 2.8 as the long run dot says. Then it's true that we are restrictive. Then you need to see the Fed cutting rates quickly. But what if our star, what if where we're going is more close to 4.5? Then we're not in a hurry. So the main test of the answer to your question is, what is the incoming data telling us? The Fed last hiked rates in July of 2023, and still now, 12, 13 months later, we're still waiting for the data to slow down, and it's not happening in any meaningful way. So if Godot didn't arrive here over the last really 18, 24 months, why should Godot arrive in August of 2024?
Some people say Godot is leaving his sort of remnants in different places and giving us a sense that maybe he's more present than we previously thought. And we're pointing to potentially some of the retail sales or some of the negative readings into the non-farm payrolls that we got a couple weeks ago. At what point do you say we still do not need rate cuts, that you have conviction based on all the strength you were just talking about, that Godot is not around, Godot is not coming, and that actually this is a very different environmental environment for the economy?
Well, I think we see that reflected in speeches by different FOMC members. Some FOMC members, including Nikki Bowman, have been saying, well, hold on, I need more evidence that we should cut interest rates. Others are more convinced. So getting the committee together for Jay Powell and making sure that the committee is moving gradually in the direction of interest rates moving lower, that does take some time. So I think they have agreed now that they will cut interest rates 25 basis points in September. But after that, I think everything is open because the data, it's not slowing down. And again, the retailers reporting earnings, and directly the Walmart CEO said, we're not seeing broad-based slowdown for the consumer. We need to take that seriously when that's 70% of GDP. So yes, I do understand that in markets, we quote-unquote want the economy to slow down, and we're so hooked on the narrative from the Fed that interest rates need to normalize. But we have plenty of time for normalizing interest rates. So that's why let's get that rate cut here on the September the 18th, and that's what Jay Powell will say here at Jackson Hole. But after that, I still think that they are open to, well, let's wait and see exactly how the data plays out.
Torsten, it just seems to me and to most people that the focus has shifted to the other side of the dual mandate. There's a focus now on the labour market, and even if you're confident, constructive about the future for risk mitigation, risk management purposes, you want to reduce interest rates a little bit from here. Maybe you go 25 and you go 25 again. But it's the other side of the mandate that has been completely neglected over the last 2 months, I would say. Inflation. You mentioned Governor Bowman. Governor Bowman talked about upside risk to inflation, reiterating her concerns, went through a long list of things: increasing geopolitical tensions, additional fiscal stimulus, and increased demand for housing due to immigration. Do you think we should be a little bit more focused on the thing we've been ignoring for the last couple of months?
So let's be, of course, clear that inflation did peak at 9.1. Now we're at 2.9, so we are a lot closer to the 2% target. But last time we looked, 2.9 is not 2. So that's why I think she's highlighting, and several other FOMC members are bringing up the same points and saying, well, let's wait a little bit and just make 100% sure that we're still moving down towards 2%. Because the risk is, of course, that if inflation does start to move either sideways or in the worst case move higher, then they will need to go back and revise their strong, just like they did in the beginning of the year. They said we have 3 cuts, now it was just 1 cut. So now the market is really getting ahead of itself. Remember also during the VIX episode and the carry trade unwind from Japan, the market was pricing that Monday that the Fed would cut 6 times. So that's why the roller coaster ride here in terms of what the market is pricing, it's important to anchor your expectations around what's the incoming data actually showing.
So when we talked to you a couple of months ago, you were saying that you could see the strength in the market certainly continuing through the end of the year on the heels of data that continued to be more resilient, stronger than people expect, but that next year it could be a problem, that you could see that fall off a cliff. Have you changed your view as you see a greater likelihood of a Fed rate cut and the potential for maybe some of the pressure to be eased before next year?
Yeah, because I do think that the main reason why the economy is holding up so well at the moment is that there's a significant tailwind from, broadly speaking, a higher stock market, tighter credit spreads, and easy financial conditions across the board supporting the economy in a very broad way. And because of that, that does mean that now we have had some correction in the Magnificent Seven. Now the stock markets are beginning to show some signs of wobbling a little bit more. They have rallied, of course, here after the carry trade unwind. But if there is any reversal in the strong tailwind from the stock market, then it would begin to have some implications, in particular for middle income and high income consumers, both those who own the S&P 500 and own their home, but also those who own credit, private credit included, where the cash flows have been basically the best levels in decades. Anyone who owns fixed income are seeing cash flows on the consumer side that are very, very strong. And that continues to be a very important tailwind to the economic outlook.
Torsten, it's been far too long. Let's do this again soon. It's good to see you. Torsten Slok there of Apollo. Much more on that debate in the next hour of Bloomberg Surveillance. And, of course, this move in Target. That stock is up in the pre-market by more than 14%. Up next on the programme, Seema Shah of Principal Asset Management, Libby Cantrill of Pimco, Jennifer Bartashas of Bloomberg Intelligence, and Anders Persson of Nuveen. From New York, this is Bloomberg.
We do expect the Federal Reserve to cut in September.
Now it's really about how quickly they get to neutral and where neutral is.
The economy really cannot sustain these rates without being susceptible to a slowdown.
What we have to remember is we don't have a lot of experience with soft landings.
They've guided us to a feathery soft landing. Just don't mess it up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning, good morning. Let's start with your scores. Equities, futures, just about positive, bouncing back from yesterday's losses, up by 0.2% on the S&P. The Nasdaq up by 0.2%. The Russell, the small caps, up by 0.6%. Your day ahead. A little bit later this afternoon, some Fed minutes at 10 a.m. Eastern Time. Revisions to payrolls through the month of March in 2024. Look out for those. We're looking for some big revisions at 10 a.m. Eastern Time. And then we're focused on the earnings this morning. We've already heard from Target and Macy's. A little bit later this morning, we'll hear from TJX. And let's talk about two very different stories this morning. Target and Macy's. Macy's is down by more than 9%. Consumers not great. Target's up by more than 12%. Call it 13%. Consumers absolutely fine. Lisa, explain the difference between these two companies this morning.
Well, there's this real issue of execution versus the macro story, and we've been trying to decipher how much, when people talk about a weaker consumer, that's because of execution. It's sort of the new weather, or whether this really is speaking to that. This is what Macy's CEO had to say, that the company saw a more discriminating consumer this quarter, talking about sales that came in below expectations, falling to 3.8% to $4.9 billion versus the expectation for $5.1 billion, also ratcheting back the revenue forecasts for the full year. That said, still delivering an upside beat to earnings because they were able to be more efficient. What's the takeaway here? Hard to get a concrete read on the consumer. Either this is an execution story at a company that's been having some issues, or this speaks of a broader macro trend. Pick your poison. A lot of people going to the idiosyncratic.
Which consumer are you going after, I think, really matters here. When you're sort of being confronted by discounts all over the place, Macy's not in a great place. And when you listen to what they're leaning into, what are they leaning into? Bloomingdale's and Bluemercury. Why? Higher-end consumer. Seen that repeatedly, aren't we?
Well, we've seen that in terms of just they have the disposable income. I mean, even the housing sector, right? That's the area that's been doing better. That said, I keep going back to execution because companies that cater to lower-end consumers, and that's why I think TJ Maxx is going to be interesting, have also shown some strength. The fact that Walmart and Target showing more sales of apparel, this isn't just an issue of lower-income consumers that are having a difficult time. There is a bigger question here, and I think that this is actually fascinating after decades of decrying the fact that low rates were creating such an even playing field, even for the companies that weren't very good. Are we seeing the good weeded out from the bad? Are we seeing some real delta between the performance of those that are strong and the weaker that can't function in a world where rates are at where money costs something?
You used the word idiosyncratic, and we used that when it came to Lowe's and Home Depot. How much heavy lifting do you think that word idiosyncratic is doing right now in the retail space to explain away contradictory signals from one company to the next?
I don't know is really the answer. When it comes to home building and the home goods stuff, that's a little bit different just because the housing market seems to be ticking to its own kind of clock, although some people say that that's telling. That's a tea leaf. We heard that from Neil Dutta. When you look at Macy's, you could say actually this shows that people have a small pool of cash and companies are getting more aggressive to get that small pool of cash for their own. And so it becomes a more difficult time for those that have any kind of weaker hand to make headway. You could cast the story in many different ways, which is the reason why you've seen narrative shift that has left everybody with a bit of a crooked neck.
The Target definitely doing better, swinging to growth. That stock is higher by 12% in the pre-market. I think we've both got that crooked neck looking at some of these moves this morning. I want to talk about some of the revisions we might get at 10 a.m. a.m. Eastern time as well. We've talked about the range of expectations. JP Morgan expecting a number of something like 300 and something thousand, revised lower over the last 12 months. The range coming out from Goldman Sachs, I mentioned this a little bit earlier, Lisa, anywhere from 600K to 1 million. That's a lower revision, anywhere from 50,000 to 85,000 jobs per month.
Which has been one of the key issues with data dependency on data that is going to get revised, and potentially significantly so, to the downward type of direction. Here's one statistic that I find interesting. A downward revision to employment of more than 501,000, and this is for the year ended in March, would be the largest in 15 years. So when you start talking about these type of numbers, does that reset the color of the discussion around the labor market and just how robust it is heading into the fall?
The Federal Reserve says it's data dependent. How dependable is that data? Equity futures right now on the S&P positive by 0.2%, just a little bit of a lift. This equity market's doing okay. Yields are higher by a single basis point, 381.80. It's a little bit snoozy in foreign exchange. Euro dollar 111.21. We're negative by almost 0.1%. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management as the rebound rally takes a pause. Libby Cantrill of Pimco with Harris and Trump on the campaign trail, and Persson of Nuveen as anticipation builds for Jackson Hole. We begin with our top story. The S&P 500 snapping an 8-day winning streak as traders await payrolls revisions and Fed minutes. Seema Shah of Principal Asset Management seeing stocks grinding higher, writing this. This backdrop is still constructive for risk, and a $6 trillion mountain of cash is ready to fuel risk assets. Seema joins us now for more. So Seema, let's go to the punchline. A $6 trillion mountain of cash. What is that mountain of cash, and why do you think it's going to be unlocked anytime soon?
Hey, John. Well, look, I think there's a couple of reasons. We've seen for the last couple of years investors become cautious. We know the reasons why. There's been COVID, there's a regional banking crisis, but also potentially most importantly is that people have been able to actually make some kind of really interest on those savings. We are on the verge of Fed cuts, likely to move at a slightly faster pace, certainly, than what people were anticipating just a few months ago. So sitting in cash is no longer going to be attractive. And I do think investors, of course, you need to take into account the entire backdrop. What are we expecting for risk assets? But we do still think there's opportunities and there's a lot of reinvestment risk.
Seema, this is the important question. What is the backdrop? Because you can have a situation where people pile into cash even more, even as rates come down, because they're looking to de-risk away from risk assets. What makes you think they're going to go in the other direction as rate cuts start to come in? What is it about the growth backdrop that tells you things are going to remain pretty strong?
Yeah, and I would say that I think in the last couple of weeks, there's been a lot of revisions. And I think it's fair to say there's increasing uncertainty at the moment. We're still in that soft landing camp. Like everyone else, we spent the last 2 weeks poring over all the data, the macro data, the consumer, the labor, balance sheets, etc. And we're not really seeing any clear signs of weakness. We know that there's an economic slowdown. That should be of no surprise to anyone. It's been underway, I think, since the beginning of Q2 of this year. But a slowdown doesn't necessarily need to transition to recession. We think that the Fed has got a lot of room to cut rates. So actually, for us, the risk of recession is fairly low. And against that backdrop, equities can still perform fairly well. We're not looking at bumper gains like you saw in 2023 or certainly in Q1 of this year, but that's still some positive gains to be made.
Seema, I love that you go here because Tracy McMillan yesterday was saying of Wells Fargo that she sees this $6 trillion in money market assets heading into equities, maybe a bit more than longer term bonds. Bob Michael of JP Morgan Asset Management saying it will flood into all sorts of core bond funds, leading 10-year Treasury yields at 3% or potentially lower. Do you agree with that type of assessment?
So I think there's a lot of opportunities across the equity set. You know, you just have to look outside the US as well. And I think there's a lot of opportunities. On the bond side, you know, I don't know if we're going to see 10 years quite that low. I think there's so many other factors at play at the moment, particularly in an election year, that at least for the time being, that downward pressure is probably somewhat limited. But certainly, I do think there's a lot to go into those core bond funds. There are question marks around high yield, around an economic slowdown, which is why there's still so much interest in that investment grade market. So actually, we think there's an opportunity set across not just equities and not just fixed income, but even across real assets. And so that's the reason why, you know, yes, the economic backdrop is a little bit more uncertain than it was 2 or 3 weeks ago, but it's still really important that investors do start to think that, look, when Fed cuts start, cash is no longer attractive, and actually staying in cash is probably going to be your biggest risk.
Going back to where we started, John, talking about a good kind of rate cut and a bad kind of rate cut in terms of what the backdrop is in terms of a good economy or a bad economy. Today, we do get those payrolls revisions, the initial payrolls revisions in the year ended in March. Expectation is fuzzy. It's all over the place. But if we see a revision of, say, 1 million fewer jobs as reported initially in that period of time, does that change your view?
It doesn't change the view, but of course it's going to add to the impression that the Fed is behind the curve and that the Fed is going to have to accelerate its movement somewhat more. It's really tough, though. You were just saying that there's a lot of difficulty, a lot of risk in focusing on just one data point. We know that payrolls are all over the place. Even if you think back just to April of this year, where you had a revision down to, I think it was the 116 mark, and then the next month it was back up to above 200. So it's really important that you look across a broad set of data, across the consumer space, also really focusing on what is the balance sheet strength of households and companies. And I think that's probably going to be very important for building up that overall picture of the underlying strength of the economy. But certainly I think it will impact Fed pricing.
Seema, let's turn to gold. Some big moves so far this year. Gold up by something like 20%, around about that. The move this morning, we're down about 0.25%, pulling back from all-time highs. UBS came out with a note recently, and they're looking for a move to 2,700 by the middle of 2025, the middle of next year. And they give a long list of reasons for this move. The Fed shift, central bank buying, portfolio hedges. What do you think the strongest tailwinds behind this move actually are?
So, look, I think the gold movement it's probably been one of the more interesting areas we've had. We've actually maintained a long-term exposure to that gold in expectation. That, as you said, a number of the factors all at play. You've got the Fed cuts, you've got the central bank buying. You've got a lot about the risky environment at the moment as well playing in. For us at the moment, I think the concerns around the slowdown, they're probably not going to go away. They're not going to be cleared up in the near term. So I think that upward movement for gold are probably here to stay a little bit longer.
What do you think it should substitute in a portfolio at the moment? Are you thinking about that, where it fits in? What are you telling people?
The gold?
Yeah.
Yeah, I mean, I think having that exposure to real assets is really important. Something around the inflation mitigation, to me, that is where gold also fits in. So I think it ticks a lot of different boxes. Somewhere along, having some kind of downward protection, but also focusing on what happens if inflation does turn out to be sticky. I know we talk a lot about recession risk, but to us, one of the key concerns that we're thinking about over the next 2 years or so is what if actually inflation does start to take off again once you've got a number of Fed cuts, and then that becomes more of a worry. So I think having that real asset exposure, commodities, anything which is a bit of inflation mitigation still deserves to be a core part of any portfolio.
Just to put a line under that, Seema, are you saying on the margins, real assets should replace long duration bonds?
I don't think that they should replace. I think that there is an area which they are ticking the box for. Long duration bonds are important if you want to have that downward, or I should say that protection against downward economic risk. Gold is a slightly different element, but I do think that across equities, across the fixed income, and the alternative space, there does need to be exposure across all three because you are ticking all your boxes in terms of the risk environment in front of us.
Interesting. Seema Shah of Principal Asset Management. Seema, thank you. The range of outcomes is that wide that you need an allocation to all three.
Because otherwise, you're not going to be hedged. This is really the issue, is that you have a bifurcated risk profile. You have, on one hand, the potential of a real negative economic backdrop that leads to inflation coming way down and rates coming way down, positive maybe for long duration bonds. And on the other side, you have inflation rearing its head, causing some sort of downturn, et cetera, which would be very bad for bonds. Either way, she's saying gold, might as well just, throw a chip that way.
It's a very dramatic conversation. There's no drama in this market this morning.
Zero.
Yields are up by about a basis point. The 10-year equity futures are positive by 0.2%. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Target surging in the pre-market after ending a string of sales declines in the second quarter, setting improved discretionary spending up 13.8%. The retailer said comparable sales rose 2% in the quarter, higher than the average analyst estimate, while breaking 4 straight quarters of contraction. For Macy's, as you can see there, not such great news, down nearly 9%. It cut its outlook for sales for the rest of the year. Revenue in the last quarter fell just shy of estimates. The company said a, quote, challenging consumer environment contributed to the weakness. The U.S. Federal Trade Commission's ban on non-compete agreements has been blocked by a federal judge. It was set to go into effect next month. In a ruling yesterday, a U.S. district judge in Dallas sided with the U.S. Chamber of Commerce and a Texas-based tax firm that sued to block the measure. She said the FTC lacked the authority to enact the ban, calling it unreasonably overbroad. This case is one of 3 lawsuits challenging that rule, with the others pending in Florida and Pennsylvania. Uber has hired a former Tesla executive to oversee the company's transition to EVs. Rebecca Tinucci will start next month as the global head of sustainability, as Uber aims to use zero-emission vehicles for all of its rides and deliveries by 2040. At Tesla, Tinucci helped open the car maker's charging networks to other car brands. And that is your Bloomberg Brief. John.
Danny, thank you. Appreciate the update. Just a quick update again on shares of Target, up in a pre-market by more than 13%. Macy's suffering a little bit. We'll get numbers from TJ Maxx later on this morning. Plenty of reaction to those numbers. Up next on the programme, we'll head to the DNC in Chicago and catch up with Anne-Marie. And around this table, we'll speak to Libby Cantrill of Pimco from New York. This is Bloomberg. Retail earnings a big focus for us this morning. Numbers from Target, numbers from Macy's. Later on today, we'll get numbers from TJ Maxx. The fate of two very different stories today for these two stocks. Take a look at Macy's and Target this morning. Macy's down by 8%. Elisa, Target up by 13%.
Both of them cutting prices, which I think is interesting. If you want to take a look at some themes, it's just that Target was able to execute more and broaden out the range of sales. Macy's coming in short for the revenue as well as sales forecast for the full year. We're going to have this conversation ongoing. I'm not going to use the I word again. I've already gotten pilloried for it.
Idiosyncratic.
How much, whatever. How much is Macy's a story of execution, and how much is it a matter of who they're targeting in terms of a consumer base? They talk about uncertainty in the consumer. Target had anything but. It talked about resilient of the consumer at a time where it really is breaking out of a funk.
If TK was with us this morning, you know what he'd say. He'd be brutal about this. When was the last time you went to a Macy's? Who wants to go to a Macy's? That's what he'd ask.
You know, and he's not wrong. And that's the reason why they're leaning into some of their more loved brands like Bloomingdale's, like Bluemercury, that cater to a higher end consumer, but also haven't been through so many cycles. I mean, the Macy's in Herald Square has gone through a number of cycles.
It's a little bit dated, isn't it?
With questions around certain things.
Not sure I want to go to Herald Square either.
Vintage.
Yeah.
I like the vintage.
You want to call that vintage?
The vintage. The vintage. The vintage escalators. Could I just say, I used to take my kids there when they were really little, just to look at the escalators and show them what they used to look like. We didn't actually buy anything. Let's move on.
Oh, trips with Bramo when you're a kid. Good stuff. Macy's down by 8%. Under surveillance this morning, a stark contrast on law and order.
Kamala Harris will deliver crime, chaos, destruction, and death. If she's allowed to be the president of the United States, you'll see levels of crime that you've never seen before. I will deliver law, order, safety, and peace.
I do believe, bad behavior should result in a consequence. Well, we will make sure he does face a consequence, and that'll be at the ballot box in November.
The campaigning continues throughout today. Anne-Marie joined us from the DNC in Chicago. AMH, what's coming up?
Well, Jonathan, you really have both of these camps leaning into different messages. Trump will be in North Carolina with J.D. Vance today talking about national security, and then tomorrow at the border. So really this idea, are you safer abroad and at home with Biden-Harris? And then Kamala Harris and the DNC is picking up on a theme of freedom tonight. We're going to be hearing from Governor Tim Walz, who she selected as her VP, an individual that really wasn't well known to the American public. He had a very moderate voting record, Jonathan, when he was a member of Congress, but then moved starkly to the left as governor. He's come under a lot of attacks about his military record and also most recently about the fertility journey of his family. He'll potentially lean in and talk about these issues, maybe clear some of that up this evening. And then who I'm really interested in hearing from is Speaker Nancy Pelosi. Yesterday at the end of the roll call, when Governor Newsom introduced California with Tupac and Dr. Dre singing in the background, he said, "I come from the great state of Nancy Pelosi." In many ways, this is her convention. We are a month out when Kamala Harris would have been speaking tonight as the VP candidate, Jonathan, on this ticket.
What a big change. in a very, very small amount of time. Anne-Marie from the DNC in Chicago, thank you. Libby Cantrill of Pimco is with us around the table. The last time Lizzie was with us, she told us to go to the beach, get a cocktail and ignore the politics. Libby, can they stay there at the beach?
Just stay at the beach.
Can they stay there?
You have 2 more weeks. Just enjoy, every ounce of sunshine and what have you. Yeah, I mean, we are telling our clients that this is still, first of all, it looks like it's a dead heat as of now. I mean, the interesting thing is despite all of the drama that we have seen over the last 6 weeks or so, and it has been dizzying, the race is effectively where it was in the spring when Biden was still at the top of the ticket. It is effectively, again, a dead heat, kind of a jump ball. The down ballot races, as we've talked about, the composition of Congress, very important to the markets in terms of fiscal policy. Right now, the House looks like it's also a jump ball. So these things have, in some ways, they've taken a round trip, if you will, over the last few months, despite sort of the dizzying nature of the events.
Do we
over the
have
last,
better clarity on policy, though, over the last few months? Have we got anything on that front?
Do we have it? So there's another thing we're guiding our clients, about is that if this is an election about personality, about vibes, Kamala Harris could do very well. If this is an election, on the other hand, about policy, then she's quite vulnerable, and you could see Trump winning. And I don't think you've necessarily seen her define her policy platform with the specificity that the policy nerds would like around the table. At the same time, I don't think you've seen former President Trump really litigate some of those policy issues. We've learned a little bit more about her tax platform. If you remember when she ran for the Democratic nomination, she had a very progressive tax platform. She certainly moderated that. But also some of the things that she's advocating still out of step. Still out of step with the market. The corporate tax rate increased from 21% to 28%. Potentially the taxation of unrealized capital gains for those making more than $100 million. These things are not likely to actually get passed, just given what looks like the composition of Congress, but also not necessarily in line with those swing voters. And those are the people that we need to get. This DNC is all about rallying the base. That's great for her, but she also needs to get those swing voters in the crucial states like Pennsylvania and Wisconsin and Michigan.
So taxes is really where she's most vulnerable. If people were actually looking at policy, is that what you're saying?
I think taxation, she's vulnerable. I think trying to separate again from that policy platform that she ran on in 2020. Immigration, though, she's incredibly vulnerable, and I think they're trying to get in front of that in terms of the law and order, but just generally the vibes on the economy, right? I mean, she's trying to distance herself in some ways from the Biden presidency, but she's still the sitting vice president. So how effectively can she do that? The big vulnerability for Biden when he was on the top of the ticket, economy, inflation, immigration, I think those still will plague her. But again, if this is about personality and vibes, then maybe she can overcome some of those obstacles.
It feels like this entire election season has been solely about vibes, and everyone has been waiting for it to change, and it never has, even with the change at the top of the ticket. The vibe was that Trump was in a better seat because he wasn't Biden and he could form a sentence better than Biden. Now there's Kamala Harris, who's in a better seat because she's a newer face than Donald Trump, and there's a lot of animosity toward him. How long can that maintain some kind of the momentum? I mean, in other words, can this just simply be the anti-Trump platform?
I mean, it could be. And I think this is the thing that's the big open question, is that can Trump litigate against Kamala Harris on policies where she's vulnerable or not? And I think that remains an open question. I mean, the last few weeks, he clearly, by I think the campaign's own admission, they've had a difficult time sort of stabilizing that campaign, reorienting toward a Kamala Harris as an opponent. So it's certainly possible. But this is where it becomes very difficult in terms of handicapping this election. I think we will get more clarity in September and October, but we're not only are we 2 months, a little bit more than 2 months out of the election, just remember that Pennsylvania, the most crucial swing state in my view, goes to the polls in terms of early voting September 16th. So this could simply be a vibes election, and Harris would benefit from that, obviously. The most compressed general election cycle in many ways.
That is not what Brahma wants to hear at all. You don't want this to be a vibes election at all.
The policy nerd on the table does not either. I mean,
Correct.
we want this to be about
amazing
policy.
that this race is as tight as it is, given that the two biggest issues are two issues that the Democrats poll really poorly on, which is the economy and immigration. This comes back to the prosecuting the case issue for the Republicans.
That's exactly what I was going to say. The whole idea of can Trump litigate this? And when people say, come on, you need to go to the policy, it hasn't panned out in the way that they've wanted so far. That's the reason why September 10th is going to be so important.
Oh, big time. Debate date. Circle that on the calendar. Libby says you can stay at the beach for another 2 weeks. Libby Cantrill of Pimco.
Thank you.
Have fun. Coming up on this programme, two very different stories in retail. Target and Macy's. Up next from New York, this is Bloomberg. Yesterday, snapping an 8-day winning streak on the S&P 500, incidentally the longest winning streak of the year so far. We came this close to the longest daily winning streak going back 20 years to 2004, falling just short of making it day 9. This morning, positive by 0.2% on the S&P, on the Nasdaq up by 0.2%. Also, lots to talk about in the bond market, so let's talk about it. The 10-year yields right now higher by a single basis point, 381.99. JP Morgan Asset Management's Bob Michael joining the program yesterday. Lisa leading the Bloomberg Surveillance newsletter with this. 3% yields or lower at the long end of the curve at some point going into next year.
And he's saying it's not really a bet on duration per se. It's just that there is that $6.2 trillion in money markets and that it's going to flood into general aggregate bond funds. And guess what? A lot of that's going to go into the 10-year. Already the 10-year around the lowest levels going back to early this year.
We'll get you some numbers from TJX in just a moment. I just want to turn to foreign exchange just briefly and look at dollar yen. Dollar yen at the moment no longer at that 160 that we were talking about over the last couple of months. We're now down to about 146.17. I just want to mention this as an excuse to tell you this. Japan hosted 3.29 million foreign visitors in the month of July, a monthly record, a 10% increase compared to July 2019, pre-pandemic.
One figure really stands out, and that is the peak weakness that we saw in the Japanese yen that some people might have nailed with their children's trips over to Japan. Here's the thing. At a certain point, you hear about tourism coming from China going to Japan in order to capture the weaker currency. You talk about the U.S. Everyone was going to Japan. Question is how much that's a boon for the economy that's going to allow the Bank of Japan to continue hiking rates at a time when they've been looking to normalize.
That's the latest on Japan. Let's get the latest on TJX. TJX, Lisa, with a better outlook looking at these numbers this morning.
Macy's is looking more and more like an outlier. They're basically raising their full-year guidance for both pre-tax profit margin as well as earnings per share, seeing full-year comp sales, comparative sales, up 3%, previously seeing 2 to 3% versus the estimate of about 2 3/4%. This, to me, highlights just how much you see some of the deals being rewarded and those that are lagging behind falling further behind. Earnings per share in the second quarter of 96 cents versus the expected 85 cents year over year. You could go through all of the metrics. Bottom line is this. There is a story that is consistent with TJX. There is a story that's consistent with Target. Macy's is the outlier. Pick your poison in terms of the narrative that you want to place around that.
You can see that based on the price action as well today. TJX up in a pre-market by more than 4%. If you look at Target, that stock is absolutely flying. Macy's is moving in the other direction. Lisa, to put it simply, what we're seeing is a better outlook for sales, better margins as well. Profits win.
We saw that with respect to Target as well. And this goes to something that people are talking about because they're cutting prices and yet they're increasing margins. This isn't an issue. A lot of people, including the companies, will say it's not an issue of price gouging. It's quite the opposite. They're dropping prices and yet efficiencies have enabled them to eke out a greater profit. Question here is how much is this artificial intelligence? How much is this, some kind of changes in different technologies that they use versus just who they're hiring? Some real questions here about why you're essentially seeing productivity increasing as they increase profit margins without necessarily increasing prices as well.
As we speak, Jennifer Bartashas of Bloomberg Intelligence is pouring through these numbers. We'll catch up with Jen in about 2 minutes' time. I just want to go through some other top stories for you. Under surveillance this morning, an Associated Press and NORC poll finding that Tim Walz is better liked than J.D. Vance. 36% of US adults have a positive opinion of Walz, with 27% holding that same view of Vance. And he wins with independents as well, which, as we know, is going to be pretty crucial going into November.
That said, when you dig into the numbers, a lot of people had no view because they didn't know either of these people, right? So you take a look at the actual underpinnings. It's hard to get a sense. There also was a significant cohort of people who did not have a favorable view of Governor Walz. I believe about some 44% versus 42% for J.D. Vance. These are numbers that really highlight the lack of knowledge around two potential running mates that really is a completely different race. And I think that's the reason why is it October 1st that you have the vice presidential debate after Pennsylvania already goes to the ballot with early voting. There's a huge discovery process here, this vibes election of 2024.
Even the former president, Donald Trump, has basically played down the importance of a VP pick, hasn't he, over the last few weeks?
Well, there's a reason for that. A lot of people say that it was a mistake. Look, he was trying to double down on his base with J.D. Vance. J.D. Vance is a polarizing figure, and that's been bearing out in the polls. Really, key question is, does Tim Walz play a bigger part in the Kamala Harris campaign, or is this basically less important at a time where people are just sort of feeling out what the right vibes are?
Bit of trivia for you. I ask this question sometimes, and I'm surprised by how few people actually remember. Running mate, Hillary Clinton, 2016. Do you remember?
Was it Lieberman?
Tim Kaine.
Oh, yeah.
Yeah, you see? Everyone's forgotten.
Well, I mean,
everyone's forgotten.
Okay, but I have a bad memory. Do you remember that?
No, I asked that question. I've asked so many people that question, and they've forgotten who a running mate was.
Do you think that it was fair that he was brought down by the roar? Do you remember the roar?
I don't even remember the roar.
He went, and then he had to step down.
On race. Do you remember Jeb Bush? Please clap.
Oh yeah.
Do you remember that?
Yes, I do.
It's a weird couple
good
of
times,
years.
Good times.
Yeah. Okay. I think we've forgotten a lot, maybe for good reason. Let's turn to Walmart, raising about $3.6 billion by selling its stake in Chinese e-commerce firm JD.com, winding down an 8-year partnership. Bloomberg learning Walmart is focusing on expanding its own e-commerce and delivery system in China. JD getting whacked. In the pre-market, we're down by 7.6%. Lisa, I just think we've seen a series of companies making some interesting moves around the story in China. And I just wonder how connected even Apple producing their iPhone, a certain iPhone in India, is connected to all of this sort of de-risking and pulling back around the story in China.
I love that you and I basically read the news the same way. We come in the morning and we're saying, wait, is this connected with Apple basically increasing production, albeit marginally in India? You see what's going on with getting out of some of their stake, Walmart, of JD.com in China. And then, of course, LVMH coming out and saying they were cutting staff at Sephora in China. Two issues here. Is this a weaker consumer in China? Or is this that U.S. companies are losing less of a competitive edge in China as some of the tensions do continue to percolate between the U.S. and the world's second biggest economy? This really is what we're watching. Question that I have also is how much are we seeing and how much are we not seeing? Because it is political malpractice or business malpractice to really say this out loud before you've moved considerable operations out of China, considering the potential retaliation from government officials.
Everyone's a diplomat when it comes to that story in corporate America, it seems. Let's turn to the retailers. Lisa going through the numbers for us this morning. TJX out just moments ago. Target surging in the pre-market. Earnings beating expectations with a boosted outlook. Macy's trading lower after cutting its forecast, citing a challenging consumer environment. I mentioned that the team of Bloomberg Intelligence were pouring through the numbers. We can catch up with them now. Jennifer Partashis joins us now for more. Jen, let's go through this. What explains the difference between what you see in a Macy's and what you see in, say, Target and elsewhere?
Well, I think what's really interesting is that, Target historically has really kept the consumer at the center of everything they do. And Macy's has been trying to execute against its strategy. But if you take just one area as an example of maybe private label, Target does a really good job of turning that over, keeping it fresh, and putting it in front of consumers. And Macy's is still in the earlier stages of really executing on private label. So when it comes to which audience they're targeting, how well they're executing, I think that's what you're seeing playing out in today's results.
Well, let's sit on the execution over at Target. Target has had some difficulties for sure over the last few years. What have they changed, and what tells you that a swing to growth can continue for this company?
Well, they had actually been on quite a tear and then had some missteps last year. Since then, what we've really seen is kind of a refocusing of their efforts. And that's a combination of making sure that they've got the right assortment. It's about lowering prices on essentials, reinforcing that value message with consumers, which is the message that we've been hearing from Walmart, what we're seeing in the results from TJX this morning. Value is king. And so the price investments Target's making, the emphasis on lower price points in discretionary categories, those are the things that are really igniting sales and bringing people back into the stores and shopping online with them.
Jennifer, how do you understand expanding profit margins at a time of lower prices and value?
Well, I think this was touched on just before this segment where you were talking about just increases in productivity. But one of the things to remember is that during the pandemic, almost all retailers introduced a lot of extra cost into their supply chains because they were desperate to make sure that they had items in stock. We're at the process still of where we're unwinding a lot of the redundancies that were introduced and a lot of that extra cost. So this year is especially in particular, a bonus year where they can take extra cost out of the supply chain. It's enhanced by lower transportation costs. That is not likely to continue into 2025 because they're sort of reaping the benefits of that low-hanging fruit. But that, along with other productivity initiatives like AI, are all starting to make a difference.
There's this issue of how much some of these results have to do with execution and how much have to do with the resilient consumer. We did hear from Target's CEO that the consumer continues to be resilient, albeit sensitive to value and albeit sensitive to bringing inflation down and keeping the price point affordable. Macy's talked about more macroeconomic pressures. Which is it? Are these specific execution stories, or is there real pressure that's limiting the overall pool of cash that consumers have to spend?
Well, I do think that there is real pressure that limits the overall pool of spending. People are still a little bit conservative. Wage growth isn't as strong as it had been in the last few years. The savings rate for people is slowing. They've burned through some of their savings. So people are spending, but they're being thoughtful in how they're spending. And so when they can achieve something with value, they feel good about their purchase and they feel more inclined to make it. So execution around that idea of how you get people to appreciate your value. And value is not just price. It could also be about quality. It could be about convenience. It could be about lots of different factors. But getting people to appreciate the value of what you offer is really what's helping drive some of these results.
Jen, just to put a bow on it, you don't offer buy, hold, sell ratings, so I won't put you on the spot to ask for that kind of thing. But are there parts of retail that you're more constructive on going forward from here than, say, other parts?
Well, I would say that the players who are in the middle and are able to service lower to middle income households, as well as drawing in more higher income households with that message of value and with strong execution, are the companies that I would be watching.
Got it. Jen, thank you. Jennifer Bartashis there of Bloomberg Intelligence. On the latest, we've heard from Macy's, we've heard from TJX, we've heard from the likes of Target, and as you said, Macy's seems to be the outlier so far this morning.
Which then goes to this point of, will some of the weaker hands end up getting weeded out in this time where money is no longer free? I do need to make a correction.
What's that?
And several people have written in to correct me on this, so I want to say thank you. I was talking about Tim Kaine going, rawr, but it was actually Howard Dean back in 2008. And what this highlights to me, I can actually draw the parallel to the whole vibe idea of a presidency. Well, isn't it the same thing if that torpedo, a candidacy, was just simply roaring in a way that lodged itself in our memories? And I think that Howard Dean does look a little bit like Tim Kaine anyway.
Well, I mentioned Jeb Bush and please clap, and that's not what basically derailed him. He was already losing, which is why it becomes so desperate. Please clap.
It's just sort of
not to go after Jeb Bush.
Okay,
Jeb Bush this morning. But yeah, a lot of these things we think they matter at the time, but ultimately it all gets forgotten years later, doesn't it?
Except that, I made a mistake, and a lot of people still did remember the Howard Dean mistake, the Howard Dean scream. Please keep them coming. I love the feedback, and it's helpful to remember that. I actually enjoyed it. It's sort of encouraging and motivational.
I'm going to find the video in a moment. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John, just to recap some of those retailers, Target is surging in the pre-market, up 12.6%. It ended a string of sales declines in the second quarter, citing improved discretionary spending. TJ Maxx also up more than 5% pre-market. It reported second quarter net sales that beat estimates, saying the growth was driven entirely by customer transactions. And as you can see there, not great news for Macy's, down 8.33% in the pre-market. It cut its outlook for sales for the rest of the year. Revenue in the last quarter fell just shy of estimates. The company saying a, quote, challenging consumer environment contributed to the weakness. Now, mortgage applications for home purchases slid last week to the lowest level since February, as tracked by the Mortgage Bankers Association. Applications to buy a home fell 5.2%. Refinancing applications also tumbled after surging to a 2-year high in the week prior. Now, all of that is despite an easing of mortgage rates, which at 6.5% for a 30-year fixed contract is the lowest since May. But housing affordability is still its worst in decades, preventing an upswing in demand. Now, on the luxury side of things, Toll Brothers is seeing a spike in demand for luxury homes as those mortgage rates fall. The home builder saw purchase contracts rise 11% year over year. While that number missed estimates, Toll said it is still seeing solid traffic and expects momentum will continue. Toll's customer base tends to be wealthier with more cash on hand compared to the average home buyer. That's keeping demand steady as competitors see sales lag. And that is your brief, John.
Danny, thank you. More on the home builders in about 30 minutes. We'll get the views of UBS. That's just around the corner. Up next on the program, a soft landing in sight.
I think they should just do nothing. All the data has come their way. They've guided us to a feathery soft landing. Just don't mess it up. Start cutting rates in September and let's get on with it.
Then everybody's going to buy bonds. That's this beautiful bedtime story for bond investors that Bob Michael at JP Morgan is telling people. And then yields are going to 3% and maybe even lower. We'll talk about that next. From New York, this is Bloomberg. Stocks right now on the S&P 500 shaping up as follows. Going into the opening bell a few hours away. Equity futures up by 0.1%. Bond yields going nowhere right now, 381.23. We'll get into a big call from Bob Michael at JP Morgan in just a moment. He's looking for 3% and maybe even lower on a 10-year over the next 12 to 18 months. Under surveillance this morning, a soft landing in sight.
If you leave restrictive rates at the level they're at currently, then that worsens the labor market. And then you've got not a problem with inflation, but the pace of disinflation. I think they should just do nothing. All the data has come their way. They've guided us to a feathery soft landing. Just don't mess it up. Start cutting rates in September and let's get on with it.
And the message after that was to keep cutting interest rates and keep cutting interest rates. And then it introduces this conversation, Lisa, about a 10-year drop into 3% and maybe going even lower.
Because it goes to that wonderful pool of $6.2 trillion in money markets that will be unleashed into income, which means further out the curve, which means it'll eventually find itself to that 10-year yield. And then you'll see that wonderful combination of both lower yields and an economy that is not falling off a cliff. I love that he says do nothing. But if he were Jay Powell, he'd get up and he'd say, I'm ready to slash interest rates. And let me tell you, this is the last time you're ever going to be able to get this kind of yield in money markets.
Yeah, Bob had a long list of things that he would like Chairman Powell to say on Friday. And then a long list of things he does not expect Chairman Powell to say on Friday. Here's the view from Persson over at Nuveen. He writes the following. We expect the Fed to cut by 25 basis points at each meeting through mid-25. Larger cuts, including a 50 basis point move in September, are possible if incoming labour market data continues to deteriorate at the same pace as the July jobs report. Anders joins us now for more. Anders, good morning to you.
Good morning.
We talked a lot about the jobs revisions we get a little bit later this morning. Torsten Slok came on the programme from Apollo and basically poured threes in cold water all over the conversation Lisa and I've been having all morning and said it won't matter to markets. Do you think this is going to matter to markets at 10 a.m.?
I'm actually more in Torsten's camp that I don't think it's going to matter a whole lot.
Why is that?
I think it's a backward-looking number, of course. It's year-to-date through March, so it's slightly outdated at this point. I think it's a number economists will definitely digest and kind of take a harder look at. But from a market perspective, I think we're really more focused on what's happening here going forward. And obviously the most recent data was more interesting and we're more focused on what's coming here going forward. So I would say historically, this has not been a number that's been all that market driven. I don't anticipate it to be today either.
Don't you think where we've been informs where we're going? And the reason I asked that question, if Goldman's right and we get a revision lower of anywhere between 50 to 85,000 jobs per month, wouldn't we have traded on that data a little bit differently over the last 12 months?
Yeah, I mean, I think today and this year, given the job markets, is very much front and center in terms of focus. And I think the market has shifted from an inflation focus to more of a job markets focus right now. So I do think this year, this time around, it's more of a more interesting data point. But At the same time, I think the numbers, if you look from like 300,000 to 1 million, the estimates are very, very wide. So economists can't even kind of agree on what a number should be here. So yeah, it's a data point. I think we have to digest it. But, quite frankly, I think the market's going to be looking more forward and to certainly the NFP number coming in September.
Part of the problem is that we've talked about the importance of data dependency, and then person after person comes on and says, but does the data actually matter? And we're left scratching our heads with our whipsawed necks and looking at all the data between Macy's and TJ Maxx and wondering what matters to anyone. You're talking about the idea of 10-year yields being in fair value around 4%. Bob Michael is talking about 3%. And you both don't see the economy falling off a cliff. So why are you not in the 3% camp?
Right. Well, I think Bob is referring to 3% some time out, right? Like I think you mentioned 12 to 18 months out. I think that's much more realistic. Right now, we're talking fair value around 4% as we're sitting here today. From our perspective, we think the 10-year is run a little bit too quickly here. It is sort of a slower kind of type month. I think there's some investors out there probably using that as a cheap option versus equity, so to say. So if we have a harder landing, they can use that part of the market to kind of hedge that bet a bit. So we are expecting the 10-year to start moving lower in 2025. We're not expecting as low as that, but 3.25 is possible by year in 2025. But that's a long time out, and the volatility has been quite severe, so to say. So today, as we're sitting here, it feels like we've gone a little bit too far, too quickly. So that's that 4% that we think is a little bit more closer to fair value.
That said, if you truly believe that the Fed was entering into a rate cutting cycle, and if you truly believe that the neutral rate wasn't that different than it has been historically, that really we just saw distortions from the pandemic, why wouldn't you hoover up as much for 10-year bonds as you possibly could right now ahead of 2025? Why wait? Why be cute about it?
Well, I mean, I think the trend is lower for sure. So that is, the backdrop that we've been saying for some time. The rates should start moving lower. I think the 2-year is going to be a lot more quicker to move, and we're expecting the 2-year to start moving lower, and we're expecting a flat yield curve by year end. We're actually seeing also an upward sloping yield curve going into next year. So, probably more comfort around the 2-year moving lower, and that's going to be more correlated to Fed cuts as we move into next year. The 10-year, again, I think the backdrop will be lower for next year, but there are a lot of moving pieces here. We've seen a lot of volatility. We have actually found more opportunity in the spread markets in general, and I felt more comfortable putting bets on that side, less so on the treasury market at this point.
Where are you on credit spreads right now? Because they've certainly tightened and come in over the last week. What are you waiting for?
Yeah, credit spreads we think are, probably fair value to a bit rich now. We have been waiting for spreads to start widening out as the economy starts slowing. It had a very quick move, 2 weeks ago or so.
About 100 basis points.
Exactly. So very quick move and came back very quickly. At this point, we're expecting that to start widening out a little bit. So high yield around 320. We could see that going out to maybe 350 again, as economies start slowing down, and we're more focused on that.
Can you walk us through your process just a little bit? Because I hear this a lot in stocks. We both hear this when it comes to stock markets. People come on the program and say they want to buy the dip. Then the dip happens and they keep running away because things get scary. You start to wonder where the next 5% is coming from, and you start to worry that it's lower. Yeah. Same thing happens with credit spreads. You get 100 basis points of widening. People start to freak out. There's another 100 basis point around the corner. How do you know when to buy? What's the process for you and the team?
Yeah. No, I mean, we debate that all the time, and I will say the credit widening we saw a couple of weeks ago was really quite tricky, given that you had the jobs data on Friday, you had the carry trade unwind, and some of the geopolitical uncertainties going on all at the same time. So dissecting exactly what was driving what and how much was technical versus fundamental was quite tricky from that perspective. I think if it was jobs data driven only, we would have had more comfort stepping in and saying, listen, this looks cheap and this is an interesting opportunity. We did step in for basically buying credit and bonds that we particularly like, take advantage of that way. But generally, I think it's an assessment that gets quite convoluted, and you have to basically take it in totality. So from that perspective, a lot of times we've seen in the past, if you have a big move like we did 2 weeks ago, it can be more coming behind it. And that is the tricky part at this point. So we're trying to be dollar cost average, so to say, a bit here, with the assumption that we're going to see spreads moving a bit higher in the rest of the year.
Just real quick, the $6.2 trillion in money markets, which asset do you think will benefit the most if people start to move it out?
Clearly, I'm a bit biased here, but I do think fixed income is going to be the natural next step here. You know, taxable fixed income and munis overall. I do think it's a pretty big step for someone who is concerned about, you know, what their views are on economy and the markets to jump all the way into equities or all the way into real estate or even private credit. So it does feel like the natural next step would be munis and fixed income. And we're starting to see and hear that more and more. And quite frankly, I think a Fed cut would probably be a nice psychological kind of step towards that, where it's reinforcing to investors that it's time to make a shift here, and that's what we're anticipating.
At least you're honest about where the bias comes from. Anders, thank you, sir. It's good to see you. Anders Persson there of Nuveen. Your lineup for the third hour of Bloomberg Surveillance looks a little something like this. We'll catch up with Sarah Hun of Alpine, Saxon Woods, John Lovallo of UBS, Veronica Clark of Citi, and Krishna Memani of Lafayette College. Looking forward to a conversation, Lisa, I have to say, on the home builders. Mortgage applications terrible this morning.
This question around, is this just an idiosyncratic sector, or is this emblematic of weakness stemming from the high rates that we've seen from the Fed?
Equity futures on the S&P doing a little bit better. We are firmer by almost 0.2%. That conversation and a whole lot more just around the corner. The third hour of Bloomberg Surveillance up next.
There's been a step up in concern about the consumer.
There's probably a little bit more downside risk in the economy than the markets may appreciate.
Good situation here. Things are indeed getting better.
There's enough good going on to offset whatever the weakness is.
Overall, the consumer is hanging in there. That's why the economy is going to continue to expand.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, 90 minutes out from the opening bell. Let's start with the scores, then we'll turn to the day ahead, and we'll get to some top stories in retail for you as well. The scores look like this. Equity futures positive by 0.1% on the S&P 500, snapping the longest daily winning streak of the year so far in yesterday's session. 8 days of gains gone, with a very small mild move lower in yesterday's session. That's the score this morning going into the opening bell. Here's your day ahead. Had a ton of earnings already this morning from the likes of TJX, the likes of Macy's and Target. Still to come, 10 a.m. Eastern time, we get the revisions to payrolls and then Fed minutes at 2 p.m. Eastern this afternoon. I want to talk about those retailers, though, that have already reported. Let's go through some of these names. Three very different stories, or I should say two very different stories for three different names. Macy's is one story. That stock is down by 6%. Everything else is kind of okay, and things are better than okay for the likes of Target. Lisa, Target up by 13% in early trading.
They're increasing their expectations for revenue, for comp sales, looking at earnings that actually came in stronger than expected, margin expansion, even as they cut prices across the board. A real question here about how much this is a consumer that's looking for value versus searching outside of just simply consumer staples. And this is what I thought was interesting. It was also the apparel areas, the non-sort of basic staples that people were going into for Target. Yes, this is an easy comp type of story also, based on some of the controversy a year ago. Nonetheless, not necessarily screaming of a weakening consumer that's falling off a cliff.
All of this informs the other stories we'll be talking about through today. Jackson Hole, the address from Chairman Powell on Friday, the retail numbers, the revisions to payrolls later on this morning. Let's wrap all of that up. This Federal Reserve thinks the labour market is strong, and because they believe the labour market is strong, they believe they have time to get this right when it comes to inflation. They have reason to be patient. This is why 10 a.m. is important. Just how strong is this labour market? Now, we've had two guests, granted, one from Apollo and Nuveen, who say that these numbers, these revisions aren't important to financial markets, or maybe won't be. Economists are taking a very, very different view of things over at Citi. This is what Andrew Hollenhorst and Citi just published. They're expecting downward revisions to payrolls of roughly 500,000 to 700,000. And they think that a notable downward revision is another confirmation, Lisa, that the rising unemployment rate has been more an accurate signal of labour market dynamics this year than maybe the signals that we're getting from elsewhere.
These are big numbers. It's hard to put them into perspective, which is the reason why I note that a revision of more than 501,000 jobs taken out of the tally through March really would be the biggest going back 15 years. When you take a step back in 2022, it made a big difference when we saw those revisions change. And it highlighted this much more robust labour market than the initial data that we got on a month-to-month basis would suggest. What this meant was that the Fed was behind the curve, and that was the reason why they had to hike rates so aggressively. Some might argue, and you could argue the legitimacy of this argument, that the Fed, if things get revised in the other direction, is working with a shorter time frame, just simply because the labor market didn't have as much momentum in it as it initially was reported to have had.
They always talk about the totality of the data. You mentioned the title of this year's get-together in Jackson Hole, Wyoming, reassessing the effectiveness and transmission of monetary policy. Wouldn't your assessment as you reassess things be very different based on whether jobs are 1 million or 1 million lower or not?
Well, this goes back to waiting for Godot, right? The long and variable lags. And if the numbers get revised lower by enough, well, hey, Godot was there all along. He just wasn't seen. And that, I think, is the real concern for a lot of Federal Reserve officials. The tone has already shifted. This is going to be a Jackson Hole that will really open the door to a 25 basis point rate cut, potentially even more in September, and then continue gradually adjusting. Whether this is the good kind or the bad kind is what we have to see, and how it affects risk assets. That's the bigger question I think people are looking for.
Without a doubt, we're both on the same page. That's the critical question when it comes to risk assets. Risks look okay right now. If you're looking at the S&P 500 up by about 0.1%, risk assets doing all right. That's the equity market. In the bond market, pretty stable and range-bound in the bond market, particularly at the front end of the curve over the last few weeks. The whole curve shifting lower yesterday, but really no drama, and no drama again this morning. The 10-year at about 381. At various points along the curve, Lisa, we mentioned it earlier, actually trading near the lows of the year for some of these yields.
As people maybe start talking less about a neutral rate that is around 5%. Remember when we were talking about maybe the neutral rate actually is where we are right now? Many fewer people talking about that as inflation does normalize. Key question that I have is, when do auctions start to matter a little bit more? We do get a 20-year auction today at a time when we do have the lows of the year on some of these longer-term bond yields. Does that reset it? Do we start talking about some of the deficit, et cetera, or does that continue to be in the back burner?
All of that still to come and a whole lot more. Coming up on this programme, we'll catch up with Sarah Hunt of Alpine Saxon Woods as the S&P 500 snaps its 8-day winning streak. John Lovallo of UBS as Toll Brothers sees a spike in demand for luxury homes. And Veronica Clark of Citi on her call for 100 basis points of cuts before the end of 2024. We begin with our top story. Stocks taking a bit of a breather this morning as traders await jobs revision data and Fed Chair Jay Powell's address this Friday. Sarah Hunt of Alpine Saxon Woods saying the following: we now seem firmly back in Goldilocks territory. Data on the labour market and jobs number revisions may yet mar that picture. And we do have more labour data coming in early September to either reinforce the start of the rate cutting cycle or throw a curveball. Sarah joins us for more. Sarah, are you expecting a curveball or some reinforcement?
I think that the consensus seems to be that those labor numbers are going to be revised down. How far down is going to be the question. And then that becomes the argument that Lisa was just making, which is, was it really never that good to begin with? And we were trading off the idea that it was so much better that we had to keep rates higher for longer. I think that the number that came out in early August was part of the swoon that happened, which is almost completely forgotten at this point because it was so quickly retraced. And I think that if that is the case and people really were worried about that, or if that was just one of the proximate things that happen at the same time, if the numbers are weak, I think that's going to be a problem. I think people are really going to start to go back into, we're going to have another complete turnaround, and all of a sudden it's going to be a recession watch. Oh my God, hard landing from what we just experienced 2 weeks ago, and now we're back to, no, it's fine, feather soft, it's all good.
Do you think we're that vulnerable? Because we heard from Nuveen, we heard from Apollo, and they say maybe this number won't matter that much to financial markets. Do you disagree with them?
I disagree just in the fact that we have so little knowledge. We don't know what's going to happen on the geopolitical front. We don't know what's going to happen with the election. If you get something that's a big enough revision down, I think the market absolutely will pay attention because it's been swinging back and forth on narratives, on different data points, because that's what the Fed has been telling it essentially to do. So I think that those numbers do matter. If they come in lighter, then they won't matter.
What matters a lot is what companies are telling us. And right now, what companies are telling us is that they're able to expand profit margins even as they reduce prices for consumers. This doesn't speak of a weak labor market going forward, because a company that has a bigger profit margin might not be looking to lay many people off. How much do you take more of a message from that than you do data that may get revised pretty significantly?
Well, I think that has been one of the surprises on the earnings front, is that margins have not been affected. And I think that there was some concern that as inflation came down, margins would come down. And this goes back to the corporations will adapt, right? Which is what Tom Keene says all the time.
TK's favorite line.
Yes. And I think that that's one of those areas where that they've managed to keep margins up has been a pretty good sign. It's been very helpful for earnings. It's been very helpful for the stock market. But at some point, those margins and wages start to argue with one another. And the question really becomes, as wages have not grown as fast, if you start to see revisions down, then you start to see some real weakness in that part of the market. And it's clear that the lower end consumer is already having some issues, and that maybe what Target is experiencing is some trade down, as is maybe some of the Walmart numbers. So I think there's a real question as to how that different segments of that market are going to act and continue to react.
I love this phrase that you wrote, blushing pessimists, because the pessimists have been wrong again and again and again, and now are left with egg on their faces. Given the potential for downside risk, how much are you positioning for that versus just going fully into risk with this idea that the Fed will be cutting rates, that there is plenty of cash to be unleashed from money market funds, and that things are okay?
Well, we do have we have broad-based portfolios, right? So yes, we are participating in the technology, but we're not 100% into technology. There are other parts of the portfolio. The equal weight S&P has finally started to pick up its head this week as well. And I think that if you are comfortable where you're positioned, the risks of the market are just there. I mean, you don't know, there could be an exogenous shock. You don't know what's going to happen. So you have to be comfortable enough with your positioning to say, okay, if this is a bigger, broader economic shock, am I okay with this, as opposed to this is a sector shock and I want to stay away from those sectors. So you have to be, it's a combination of how you put those portfolios together. But there is, I think, some risk in the market just from a valuation standpoint. But I think that if we got some good information going into 2025, then people are going to start to look to that year anyway. But we have a lot of things in between now and then.
Conviction longs for you. You mentioned the equal weight, record high on Monday. What are the conviction longs for you at the moment?
Well, I mean, we still participate in the big technology stocks. You kind of have to. I don't see how you can't, since they're the companies that are spending the most money and have the most cash. But if you look at some of the areas, I know that we've talked about energy over and over, and if there's a recession, you're going to see some problems. But you are finally coming to the realization that conventional hydrocarbons are not going away in the next 15 minutes. And I think that has put that back in an investment class where you've got some very good returns on investment now. You've got some very good dividend yields. There are places where you can feel more comfortable. And I think that those are you look at both sides of those equations.
So the haven, the downside risk, is it $1 million gold bar that's hard to lift?
Well, I'm not going to lift those weights at the moment, but I do think that there's nothing wrong with looking at all the different asset classes. And certainly the fact that gold has continued to do well in both adverse and non-adverse circumstances over the year, I think does say something. I think it says more about what central banks are doing, but I think that there is some concern that that currencies globally fiat currencies are, compared against gold, they're going down, right? So I think that there's a reason why people use that in portfolios, and those mining stocks have finally picked their heads up too. They were not tracking gold, and they have finally started to.
Those old-fashioned gold heist movies where they're just sort of throwing around gold bars like they're nothing, 400 ounces?
So fake.
It's ridiculous.
Absolutely awful.
Can you imagine how many could you actually carry out of the bank if you were to deliver an old-fashioned gold heist? How many do you think you could carry?
Easy.
Hardly any.
Yeah.
I don't know how many I'd need. Like 10's the retirement package, right? You just need sort of 10 if you can carry them out of there.
Yeah.
I'm not suggesting anyone does this.
Is this where your mind goes, the retirement package?
They're so heavy.
How many could you actually carry? But it's true. They just sort of throw the bag over their shoulder.
Like they're just tossing them to each other.
I love those heist movies.
I know. Same. They need to bring some back. Sarah, thank you. It's good to see you. Sarah Hunt of Alpine Saxon Woods. Let's take the opportunity to get you up to speed on some stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ford is pulling back on its electrification strategy yet again. In an announcement moments ago, Ford said that it's canceling plans for a fully electric SUV, which may cost the car maker about $1.9 billion. Ford will also postpone a next-gen electric pickup and reduce spending on EVs to 30% of its annual capex. It was 40% previously. CEO Jim Farley told Bloomberg in an interview that the pullback was in part to make sure that there are affordable vehicles that meet their criteria of profitability when they do launch. Target is surging in the pre-market this morning. It is up 13.8% after ending a string of sales declines in the second quarter. They cited improved discretionary spending. TJ Maxx, you see there, also up in the pre-market, 3.6%, reported second quarter net sales that beat estimates. They said the growth was driven entirely by customer transaction. On the other side of things, there is Macy's down 6.7%. It cut its outlook for sales for the rest of the year. Revenue in the last quarter fell just shy of estimates. The company said, quote, challenging consumer environment contributed to the weakness. Texans have set an unofficial record in electricity use. According to the Electric Reliability Council of Texas, air conditioner use yesterday pushed the power grid above a record set last August. Parts of the Lone Star State experienced dangerous conditions as the heat index soared. And that's your brief. John.
Danny, thank you. More from Danny again in about 30 minutes' time. Up next on the programme, we'll get you some morning calls and we'll catch up with John Lovallo of UBS as Toll Brothers sees continued demand into 2025. That's just around the corner from New York. This is Bloomberg. The opening bell is 1 hour and 14 minutes away. Just to work through some of the price action for you. Equity futures positive by close to 0.2%. Pretty stable in the bond market, 381. Plenty of big moves in retail. Target absolutely ripping in early trading going into the opening bell. The numbers much better than expected. It's a return to growth. So a great start for the retail earnings a little bit earlier on this morning. Not so great for the likes of Macy's, Lisa, and that struggle being explained away throughout this morning so far.
Talking about how there is a more constrained consumer at the same time that you hear something very different from Target. At the same time, this comes from sales coming in lower than people expected. Even though they were able to eke out a bigger profit, this is a question of getting people in the doors at a time where there are questions about Macy's competitive edge.
Yeah, in the door at places like Macy's, not happening in the same way. They're talking about better store traffic, by the way, at Target. That's what they're talking about this morning.
Precisely, including comparative sales, which is the reason why the shares are increasing so much. Not the same story. Fewer sales when you take a look at the likes of Macy's.
Very different. One to watch, a theme to watch going into the opening bell. Let's get you some morning calls. First up, Citi opening a 30-day positive catalyst watch on Gap. The analyst anticipating a big second quarter profit beat and upbeat sales guidance when the retailer reports next week. That stock is up by 3%. Next up, Bank of America downgrading American Express to neutral with a 263 price target. The analyst pointing out commentary from retailers and travel companies that points to a challenging spending backdrop. A stock is down by 1.2%. And finally, UBS maintaining its buy rating on Toll Brothers. Analyst John Lovallo saying that there's a lot to like in the home builder's latest earnings report, noting that an upwardly revised forecast should overshadow a miss on orders as Toll expects continued demand. Their stock is up by about 1%. And John's with us now. John, I've been looking forward to this, so thank you very much for joining us, sir. I want to dive straight in, but take a big step back at the same time, because I want to talk about the bigger theme around the home builders for the last year or two. John, how they've done so well, how they've thrived in a high interest rate environment. Can we start there, the factors behind all of that?
Sure, Jonathan, thanks for having me. It's a very interesting dynamic out there for the home building industry and the public home builders specifically. To your point, existing home sales have been lackluster. There's been a lock-in effect where folks are just reluctant to sell their homes because they have a 3.5% mortgage or whatever the case may be. What the public builders have been able to do very effectively is buy down mortgage rates and offer other incentives that make the affordability equation work for a broad range of buyers. And so they've been able to kind of step in and fill the void where there's just been no existing home inventory. So that underlying demand has to go somewhere, and it's going towards new construction, and the public builders are really kind of taking the baton.
John, one question we have is what it would take to unlock some of that inventory to boost supply just a little bit more. And I know you've noted this in your research, but I just want to go through some of the numbers for our audience who maybe don't follow it as closely. The effective mortgage rate in this country is something like 4%. So that's the average rate on outstanding mortgages. The market rate, if you wanted to go and get a mortgage right now, would be something a little south of 7. So that's quite a wide spread at the moment, John. And as you've noted, and everyone in the industry has noted, that's why inventory has been so low. John, how tight does that spread need to be to start to encourage some of those properties to come back on the market?
Yeah, sure. I mean, let's put a finer point on it. 80% of mortgages are below 5%, 60% are below 4% in the US. So that bar is fairly low. That being said, as we know, life goes on, Jonathan, right? And so I think even if rates were to stay at current levels, at some point, folks are going to adjust and the transactions are going to pick up. And we need that to happen. The existing home market is essentially dysfunctional at this point. It's frozen. We're at under 4 million units. That should be closer to 5.5 million units. And remember, at the other end of an existing home sale, there's typically a home purchase, and that could be a new home purchase. So it's not a zero-sum game here, and it's not a death knell for the home builders to have that inventory come back. So long and short, that inventory will eventually come back regardless. But I think that as rates trend lower and we start getting a little bit closer to, a 6 handle on the prevailing rate, that's going to be pretty helpful.
So this is the 30,000 picture view, which is frankly what a lot of people are focusing on in the political season, as well as just trying to understand when they can buy homes. Drilling into the likes of Toll Brothers, how much is this a story of a company that caters to higher end consumers that have the capacity to buy a home in a way that the vast majority of people, or most of certainly people who don't own homes, are struggling?
This is a great question, Lisa. And look, I don't think it is that case. I think you're absolutely right. Toll is the premier luxury home builder, and they are the build-to-order builder that's been doing this for a very long time. However, what's been so unique about this cycle is the builders have all adjusted, including Toll. Toll is now delivering 50% of units, 50%, that have been started on spec. So actually, production has started before there's a buyer in place. That's a strategy that has historically been used by kind of lower-end, entry-level, first-time buyers. And about 45% of their portfolio is geared toward what they call affordable luxury. So yes, that higher end buyer has been more resilient, but Toll is really kind of playing through the entire curve of buyers, which has served them incredibly well.
How much is this really a broad story versus a Toll Brothers story? And I say this because home building starts actually have fallen. We have seen actually fewer home builders start to expand, and we're seeing some more modeled performance from a number of other players.
So Toll put up a great quarter, so I don't want to take anything away from them. But this is really a story of public home builders, right? Builders with balance sheets, size, scale, and the ability to outperform their smaller peers, which are about 50% of the new construction market. And by the way, the existing home market just doesn't have the inventory to cater to the demand. And so it's really a function of the public builders stepping in, taking advantage of the situation.
John, how closely are you listening to some of the rhetoric on the political sphere about $25,000 incentives to allow first-time home buyers to make down payments? Do you think that this signals some sort of policy shifts on the burner? And two, do you see this as really highlighting some of the vulnerabilities for home builders at a time when their industry is very much front and center from a political perspective?
It's a great question. Look, there's no question at all that affordability, housing affordability, is a huge topic, and it's a huge concern out there. It's a real pinch point for the industry, including for the public home builders. So if there is some sort of stimulus that can be targeted towards helping people get into homes, that could be helpful. Frankly, I think that the public home builders would probably prefer the government to stay out of the home building industry as much as possible. But that said, if we can get some stimulus to put a little bit more money in the pockets of folks, that would be beneficial.
John, can I ask you a direct question about how many homes we're actually building in this country right now, whether we're running below average, and what a government could do about it? When you hear a number like, I want to see 3 million new homes built in my term across 4 years, just how realistic are those kind of numbers?
Yeah, our estimates would suggest that we're about 2 to 3 million units underbuilt here in the U.S., dating back really to the global financial crisis. The challenge, Jonathan, here is that even if the builders wanted to build a lot more, there's just capacity constraints. There's not enough construction labor. There's entitlement and sort of permitting delays at each municipal level that it's just, frankly, would be incredibly impossible to ramp production to the levels I think that would be needed to put that kind of supply into the market over the next 3 years to fill the gap, unless demand were to fall off a cliff and everyone just continued to build. So I don't know, frankly, how realistic those numbers are unless there is a step change in the actual process of getting land ready to build upon, and there was an influx of labor to come in to kind of, to make the process a little bit more efficient.
John, this was excellent. We've got to do it again soon. Thank you, sir. John Lovallo there of UBS on the home builders in America. We talked about this yesterday. Demand-side solutions, supply-side incentives. The supply side is so much more complex when it comes to this story than it is when it comes to compare, just say, boosting demand, incentivizing demand. One is much easier than the other.
And talking about getting rid of red tape isn't as attractive of a political proposition as, say, $25,000 in hard cash. And that's kind of the messaging parsing that we're hearing. How do you get rid of that red tape when you're dealing with not in my backyard and you're dealing with different types of permitting constraints? And that's really what John was talking about.
Effort's got to be federal, state and local. Everyone's got to come together, do it all at once. Ultimately, we talked about this yesterday, it will lead in the near term, and I don't know how long the near term is, to higher prices, right? Demand-side solution, supply-side problem.
If they get this through, which is a huge if considering
Sure.
the composition of Congress. But yes, that is the large takeaway that I've gotten from most people.
Most people, including the people around this table. Up next on the programme, Veronica Clark of Citi, Krishna Memani of Lafayette College. All of that and more from New York. This is Bloomberg. 60 minutes away from the cash open with equity futures right now. And the S&P 500 positive by about 0.2%. Likewise on the Nasdaq, similar move elsewhere. On a Russell, the small caps were doing better here by 0.5%. So looking to bounce back from those small losses yesterday. Lots of data to look ahead to. Jobless claims coming up tomorrow, and we'll get some job revisions later on this morning at 10 a.m. Eastern. We'll talk a lot more about that in just a moment. I want to go through the scores in the bond market for you. The 2-year, 10-year and 30-year shaping up as follows. The 2-year 398, the 30-year down to about 4%. I talked about various points along the curve being near the lows of the year. The 30-year is one of those points, and if you're worried about the mortgage market and interested in borrowing sometime soon to buy a home, the conversation we had about 15 minutes ago might be of interest to you. Just the gap, Lisa, this spread between what the effective mortgage rate is right now, which is basically the average mortgage rate of outstanding mortgages in America, which is something close to 4, and what you'd be borrowing if you went and took a mortgage out today. That spread is still very wide, something like 300 basis points.
Yeah, talking about a 4% effective mortgage rate versus this sort of roughly 7% mortgage rate currently if you were to take that out. Yesterday we were talking with Neil, which I think Neil Dutta of Renaissance Macro. I loved his point, saying stop dismissing the housing market as something of an outlier that's been uniquely affected by the Fed's higher rates. This is emblematic of a situation that is building on itself where people don't afford homes, can't afford homes, and there are distortions that can only get unwound if mortgage rates get down to something like 5.5%.
MBA mortgage applications this morning, that data dropped to 7 Eastern, down 10.1%. Home improvement companies struggling as well. We've seen repeats of this, echoes of this across this sector.
This is the reason why I really am excited about Jackson Hole this year. The idea that the theme is the idea of assessing the effectiveness of monetary policy at a time where they have control over the front end, but not necessarily the long end of the yield curve. That is not where they are focusing unless they start some sort of quantitative easing once more, which is politically a hot potato considering how big the balance sheet already is. This comes at a time where, yes, you have seen calm in the long end of the yield curve, but today we've got a 20-year auction, some $16 billion. Later in the year, we have the potential politically stemming turmoil. How much control do they have over the long end, which is one of the key transmission mechanisms of their policy?
I'm almost laughing, and you can tell.
I can tell.
I'm almost laughing because I'm trying to work out whether you are genuinely excited for Jackson Hole or just trying to convince yourself before you get on the plane later this afternoon.
Okay, look. I think it's always interesting. I think, I am interested in the philosophical discussion around the efficacy of interest rates. Whether that will make good TV, I will let you decide. But I do think it's going to be compelling, and I think these are important debates. No one will give any answers, which also is difficult to really square. I think it's a beautiful place. I'm looking forward to kayaking on Jenny Lake.
The diner's great too. The diner's great too.
The diner is wonderful, and there's some really great people. And to me, to hear some of the ideas is actually very exciting.
That felt a bit more authentic. I'm looking forward to the coverage. It kicks off Tomorrow and on Friday as well at 9 a.m. Eastern time, so look out for that.
I hear you're not going.
I'm not going, no. I got out of it this year.
Because
I'm not sure if this is a conversation we should be having live on TV.
Move on.
But yeah, I won't be there. Under surveillance this morning, top stories for you. Two different stories from retailers, Target and TJX, boosting outlooks on the back of improved discretionary spending. Macy's cutting its annual forecast, citing a challenging consumer environment. What is idiosyncratic, what is real, and what is evidence of a real consumer slowdown? Target says no. Other companies say there really is one.
Challenging consumer environment, meet off with what we heard from Target, which is the resilient consumer. And this really becomes this question of, do you start to see commentary like it is a tough backdrop as the new weather argument, as the new currency valuation argument? It's basically an explanation for an execution issue. And that, I think, is what you're seeing in the price action. This stock market got a lift after the Target earnings. And you can say it's because it's a quiet market with very few catalysts. But nonetheless, people are taking more of a signal from the resilience than they are from the weakness that we're seeing in the likes of Macy's.
Stocks are picking up on the S&P, up by about 0.2%. I'd like to turn to this story. It's an important one in this country. A federal judge in Texas ruling that the FTC cannot enforce a near total ban on non-compete agreements. The judge signed in with the plaintiff and the U.S. Chamber of Commerce, saying the FTC lacks the authority to enforce such a ban. An estimated 30 million Americans are subject to non-compete agreements. Lisa, this story is actually really, really complex. If you work for a company and you're paid a certain amount of money and you have a certain amount of knowledge as well, and you can just walk away and take it with you and go somewhere else to work, I think you can make the argument that you need non-competes. If you're at a fast food company and you're being prevented from going across the road to go and work for another fast food company, and that's suppressing wages, then we've got a very different problem. How you tackle this issue is difficult. How you work through these problems is quite hard.
How you craft a law to be specific enough to be constitutional is also part of the issue. How do you craft something that is general enough to encompass that type of abusive behavior where you're preventing someone who works at a fast food restaurant from going to another place versus something that seems rather reasonable is part of the reason why courts are having trouble with this. Lena Khan, who is the head of the FTC, is really going to ongoing face this challenge, the idea of how do you get specific enough to avoid constitutional questions about whether this is not a fair, due process of law, whether there sort of could be an arbitrary enforcement versus going after practices that are punitive, that a lot of people would agree are not right.
We should be able to have just objective, rational conversations about something like this. We'll let the lawyers deal with the legal stuff, but just an objective, rational conversation. Do you need non-competes in the food and hospitality business? To the degree that they exist, probably not. Do you need them for high finance and tech when we're talking about company secrets? Likely you do in specific cases.
But then how do you craft a law around this?
With great difficulty.
And that's, I think, what they're facing off with. It's sort of the silver bullet of the policy spaghetti that we keep hearing about, that a lot of these broad sentiment sort of declarations are better in sentiment than they are in actually getting across, just simply because it is hard to craft a law narrowly enough to make that distinction.
That is an ongoing fight, an ongoing story, and we'll bring you the latest when we get it. Let's turn to the latest when it comes to the jobs market. We're looking ahead to 10 a.m. Eastern when the BLS releases its preliminary annual payrolls revision. Wall Street economists expecting the US jobs growth through March was likely weaker than initially estimated, adding concerns that the Fed might be behind the curve. Now, Lisa, when it comes to these revisions, it is anything from 300,000 to 1 million, based on what I've seen from economists on Wall Street, that we might see in terms of a lower revision to payrolls growth over the last 12 months ending in March.
JP Morgan calls for a decline of about 360,000. Goldman Sachs, as you've mentioned, goes anywhere from 600,000 to 1 million jobs that are removed from the overall tally in the year through March. Question is how the market will respond. We had the likes of Torsten Slok saying the market won't care. We have other people saying it could actually very much color how people view the labor market in terms of where we're coming from, and Sarah Hunt was in that camp. We'll see at 10 a.m. Eastern.
Just around the corner, we'll get you more opinions on this as well. Those jobs revisions could shape the tone of Fed Chair Jay Powell's remarks on Friday in Jackson Hole. Veronica Clark of Citi writing the following: we expect 50 basis point rate cuts in both September and November. But Chair Powell will not want to make any commitments on the exact policy decisions the Fed officials will make in coming meetings. He will remind us repeatedly that these are data dependent. Veronica joins us now. So, Veronica, we need to talk about how dependable that data actually is and the scale of revisions that you're expecting in 90 minutes' time.
Yeah, I don't think I've ever gotten so many questions on these preliminary benchmark revisions to payrolls before. But based on the official payroll data, the QCEW data, which we do already have for 3 of the 4 quarters of this annual revision, it does look like something like 500K, 700K downward revisions to payrolls. I think that's pretty much expected at this point, but that is a pretty substantial downward revision.
So, Veronica, here's the issue. How will people take this? We have some people like Torsten Slok and Anders Persson saying it won't actually matter all that much, considering the strength that you're seeing elsewhere. And then other people saying it'll actually make the labor market look much worse heading into a Jackson Hole where clearly this is a Fed Chair Jay Powell who wants to cut rates. Which is it?
Yeah, I think usually these revisions don't matter too much, but they do matter a bit more than usual this year because we've had such diverging signals between all the labor market data that we have. Most importantly, very strong payroll job growth, but much weaker employment in the household survey, that rise in the unemployment rate. And there has been a debate, which one is the accurate signal. And if you were relying on strong payroll job growth and that now looks a little bit less true, it's just looking increasingly like that rising unemployment rate is the better signal for what's happening in the labor market.
Torsten Slok was on the programme about an hour ago and he was saying there is no slowdown. There's nothing to worry about here. Veronica, you're looking for some punchy moves from this Fed. 100 basis points across 2 meetings, 50 in September, 50 in November. What does the data need to look like on September 6th for you to sit there at Citi and say, yep, green light, 50, September 18th?
Yeah, I actually think the bar for starting with a 50 basis point cut in September is actually pretty low. I think the issue is it's just been multiple months now where the unemployment rate has been rising. Certainly if we get these downward revisions to previously strong payroll job growth, 1 month of data that, data for August on September 6th is not really going to skew our assessment that there are really asymmetric risks around the weaker labor market. I don't think that's going to, one print alone is going to, give the Fed a lot more confidence that maybe the unemployment rate won't rise anymore. So I think it's pretty easy for them to start with 50 in September.
Why do you think the bar is so low, given the fact that they're not forecasting it in that own statement of economic projections? And you're looking at an unemployment rate that's still fairly low, with retailers reporting fairly strong earnings.
Yeah, the unemployment rate is low and it has been, and it would be fine if it stabilizes here. But I think just each month we see it not stabilizing. You really are risking, getting to that point of nonlinear weakening in the labor market. Once you do start to see things like building job loss, that's really when it's too late, and that's what the Fed wants to avoid. And I think most Fed officials would agree that they are far from neutral here. The cost to starting a bit big and getting quicker back to neutral is pretty low.
So this is the study of economics. Can we do a little bit on sociology as well? Just how this is going to work on the FOMC when they get together for that 2-day meeting on the 17th. Is unanimity important to Chairman Powell? Does he need everyone on side?
I think he does want to definitely build consensus. Maybe you can have one dissent. We do have hawks like Governor Bowman. Maybe something like that is a dissent. But I think, he wants to build unanimity. But I think most people will probably be coming around to that cut. We've even seen a shift in rhetoric after CPI last week. People who are saying we just need a bit more information, a bit more good inflation data. And once we got that last Wednesday, even the rhetoric from some of those hawks has pretty quickly changed.
Well, this is what I'm trying to gauge, just how high the bar is. You say it might actually be quite low, but what I hear from Governor Bowman is maybe I'll consider it. What I hear from Kashkari, another hawk on the committee, maybe I'll consider it. Consider a cut. That's before we even start to discuss 25 versus 50, and it's the 50 piece of it. Just wonder, Veronica, how much of a sticking point you think that might be on the committee?
Yeah, I do think you'll probably see some agreement, of course, depending on that August employment report. That is going to be very important. But I think even if the unemployment rate stays at 4.3%, even those hawks will see that the risks are really asymmetric around the labor market. We've had better inflation data. We've only had worse employment data. The cost of starting a bit big is pretty low. They did that in 2007. They did that in 2001. It's really not unheard of.
Do you think basically that would be a concession that they made a mistake at a time when the likes of Mickey Bowman is talking about it might be appropriate to gradually lower the federal funds rate? We heard the same thing from Mary Daly, the importance of being gradual, of being slow. How much is that sort of a negative signal if they go 50?
I think 50 could even still be considered somewhat gradual. I mean, rates are really high here. We do have them going to 50s, but then slowing to 25s. I think they're obviously, still focused on the inflation side of things, but the risks are just really quickly shifting to the labor market. It's not necessarily a mistake. It's just shifting priorities pretty quickly.
Sticking with 50 over at Citi in both September and November. Veronica, thank you as always. Veronica Clark of Citi. Looking ahead to that Federal Reserve meeting next month, the Jackson Hole address from Chairman Powell and the revisions to payrolls that we get at 10 a.m. Eastern Time. With us around the table, Krishna Memani of Lafayette College. Krishna, an easy one for you. What happens if Veronica's right and the economy falls off a cliff and the Fed starts to move in 50, 50 and then 25, 25, 25?
So all of those people who are looking for Fed easing to help their risk portfolio would be holding their head and crying. The bottom line is, if they actually cut 50, given what they have already said and what the construction of the FOMC is, that means things have gone really south really quickly. And if that's the case, I think we are in bigger trouble than we think we are in today. I don't think that is the case, and that's why 25 basis points remains my base case. Powell in his last presser basically said we are not even considering 50. And since then, the data, it has kind of gradually softened, but hasn't softened as catastrophically as people want us to believe, especially somebody like Jeremy Siegel looking for an emergency cut. Clearly, that certainly hasn't been the case.
Yeah, I have to say that conversation sounded ridiculous at the time, and it seems even more ridiculous a few weeks later. Krishna, you say the biggest challenge here is valuations, and that you're not encouraged by the vicious snapback we've seen. In fact, you find it unsettling. Can you just walk us through in some detail why?
Sure. So if you look at the basic economic data, it has been supportive for the markets for quite some time. That is, we have decent growth, inflation slowing down, and the Fed on the verge of cutting. So all of that is extraordinarily supportive. But if you look at valuations, whether it's in the credit markets, whether it's in the equity markets, clearly they are very, very stressed. I mean, they're not overly stretched, but they are definitely stretched. And then when we had a correction, and it was driven more by market positioning rather than weaker data, or at least the reaction was far more disproportional relative to what the economic data was, that sort of indicated that the market position is really offside. And if we had kind of stayed there for a long time and come back, then some liquidation of positions would have taken place. Instead, what has happened is we have not only taken back all the positions that we liquidated initially, we have probably piled on a bit more. At least that's my sense. I hope I'm wrong. But it would have been much more helpful if the grind out was slow and steady rather than a real quick snapback.
Let's put these two ideas together. The idea that if the market did get a 50 basis point rate cut, the people who are heavily into risk assets would be holding their head and crying. They wouldn't be sort of celebrating at the same time that you see market valuations as being too high. Are you saying you're getting less constructive on risk assets because the Goldilocks scenario that people are pricing in right now seems implausible?
Well, so I would say that the base case for the market right now, what we are discounting is all in on soft landing. So the likelihood, and it's quite likely that we will probably get it. And in that scenario, it's very plausible that we don't have a significant correction and we grind higher from these levels rather than going lower. What I'm talking about is in a risk scenario where things slow down much more than what we are anticipating today, there's really no margin in the market valuations today. And in that scenario, there'll probably be a substantial correction than otherwise.
Heading into an hour and a half from now, when we get those initial revisions, I wonder how coiled this market is to some sort of really more significant downward revision to the number of jobs created in the United States in the year through March. Are you saying that even a small type of catalyst could create a disproportionate event in the market akin to what we saw last week?
I think the risk of that is substantially higher than it has been in the cycle at any other point. Primarily because things are slowing down. And if you corroborate that story with these types of revisions, I think there is a potential for that. I don't really think that. I think revisions became a political question far more. If this wasn't an election year, I don't think we'll be talking about revisions the same way that we are talking about revisions.
You've got to build on that. Why is that? Why do you think it's so important for the politics?
Well, it's important for the politics is because that is being used as a ploy for, somebody is gerrymandering something to demonstrate something. And that gets a lot of traction in social media. We have seen that all over the place. And I think the hoopla is more about that than it is that revisions are going to be 300,000 or 400,000 or 1 million. That it has happened, throughout for a very long period of time. And I think for employment, what is far more important is not the absolute number. It's really more the trend.
What is the trend?
The trend is the labor market is slowing, but not slowing as catastrophically as some of the bears would have us believe.
We need to have a decent idea of what normal is supposed to be to sort of benchmark that. What do you think normal is?
I think 150,000 is probably a good normal number.
Okay.
And if we get that, and unemployment rate may tick up a bit, but I don't think that is slow enough for the Fed to kind of, having said that they're not considering 50, for them to consider 50 as a result.
We've heard a few times from people that the Fed is offside, and maybe offside by as much as 100 basis points already, perhaps even more. Listening to you, you're a little bit more constructive versus some of those voices. How offside do you think the Fed is currently versus the 5.5% we're at?
Well, so I think if the question is the Fed, have they delayed the rate cuts for all sorts of pressures that they have faced over the last 2 years? The answer is absolutely they have. If they hadn't missed the boat the way they did in 21, I think we would be further along in the rate cutting cycle than we are. And that's a historical legacy. That's a baggage that we have to accept and deal with. Yep. It's never about what the Fed should do. It's what the Fed is going to do and what they are telling us. And we should take them at face value is that, yes, we will cut, but we'll be very methodical. And if the data gets us really scared, we'll cut more expeditiously. But that's not the case today.
There's a lot of people listening to this just sort of doing this, nodding their head to Krishna as he speaks. Krishna, thank you. Krishna Memani of Lafayette College. Appreciate it, sir. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Hamas and Israel are still divided over an American proposal to pause, if not permanently end, the war in Gaza. U.S. Secretary of State Antony Blinken met with Egyptian and Qatari officials yesterday. He reiterated that Israel has agreed to what the top U.S. diplomat called a bridging agreement that would create space for the two sides to hammer out the details of a ceasefire introduced by President Biden in May. He said it's Hamas's turn now and time is of the essence. Uber has hired a former Tesla executive to oversee the company's transition to electric vehicles. Rebecca Tonici will start next month as the global head of sustainability as Uber aims to use zero-emission vehicles for all of its rides and deliveries by 2040. At Tesla, she helped open the car maker's charging network to other brands. Speaking of EVs, Ford is pulling back on its electrification strategy yet again. Earlier this hour, Ford announced that it's canceling plans for a fully electric SUV, which may cost the car maker about $1.9 billion. Ford will also postpone a next-gen electric pickup and reduce spending on EVs to 30% of its annual capex. It was 40% before. CEO Jim Farley told Bloomberg in an interview that Ford wants to make sure cars launched fit their criteria of profitability. And that's your Bloomberg Brief. John.
Danny, thank you. Thanks for this morning. Up next on the programme, setting you up for the day ahead. And we'll touch base with Anne-Marie at the DNC in Chicago. All of that and more. Up next from New York, this is Bloomberg. The opening bell about 37 minutes away. Equity futures positive by 0.2% on the S&P. Your trading diary for the week ahead. Your calendar looks like this. At 10 a.m. Eastern this morning, we get the annual payrolls revision. So much more focus on this time around. Followed by Fed minutes at 2 p.m. Eastern. Thursday, another round of jobless claims plus US PMIs. And Jackson Hole and the annual Fed get-together begins. On Friday, we get the main address from Chairman Powell. Turning to the other main event this week, the DNC continues in Chicago. Tonight, we'll hear from Kamala Harris's running mate, Governor Tim Walz of Minnesota. And tomorrow, Harris will deliver her acceptance speech. Anne-Marie joins us now from the DNC in Chicago. AMH, walk us through the next 24 hours.
Well, Jonathan, we're going to be hearing, as you mentioned, from Governor Walz. This is really a moment for him to introduce himself to the American Republic. Remember, this individual is not known by most of America. He was a congressman, he was a governor of Minnesota, but he didn't have that national appeal the way he does now. So we're going to hear a bit from him, and he's come under fire for things like potentially insinuating some of the fertility uses his family went through to build their family, as well as his military record. So potentially we'll hear a little bit of that from him today. We're also going to hear from Speaker Nancy Pelosi, and I'm really interested to hear what she has to say. In many ways, this convention is the way it is because of her, because of the pressure she put on President Biden to drop out, because the concern she had about what him on the top of the ticket meant for those individuals in the House seeking re-election or the Senate. And yesterday, when Governor Newsom was closing out the roll call in California, he said he came from the great state of Nancy Pelosi. So I want to hear what she has to say. And then, of course, all eyes will be on Chicago Thursday evening when Kamala Harris accepts the nomination officially, really a coronation here in Chicago. And at the same time, Donald Trump will be at the border trying to distinguish himself in terms of policies between what his campaign looks for in a Trump 2.0 versus what the Democrats are vying for.
Looking forward to your coverage with the rest of the Bloomberg team. Anne-Marie on the ground in Chicago at the DNC. All of that still to come, plus our coverage of Jackson Hole, Wyoming and the annual Fed get-together. Bramo heading to the airport in about an hour's time.
Pretty much. I actually think this is actually going to be very important. And I understand we've been a little tongue-in-cheek because they're not going to basically come out and say we're going to cut by 50 basis points. Nonetheless, the key question of understanding the long and variable effects is key, central to this market. And frankly, expectations of rate cuts has been what's been fueling this incredible rally that's left stocks near their all-time highs.
I'll be holding down the thought. And here's the lineup. Matt Hornback of Morgan Stanley, Sam Stovall of CFRA, Aditya Bave of Bank of America, and Mohammed Al-Aaron of Queen's College, Cambridge in the studio. We'll speak to Mohammed for the best part of 90 minutes to work through some of these major issues. It all comes down today, apparently, the fate of this market in the hands of revisions at 10 a.m. Eastern time. Lisa, which happen quite often, but this time, this year, seems to be a much, much bigger deal for a lot more people.
Well, Krishna Memani is saying that it's somewhat political in terms of gerrymandering and other situations. There is a lack of credibility in some of the data in terms of surveys not being as well responded to. And that, I think, is underpinning some of these revisions.
The Fed talks a lot about data dependence. How dependable is that economic data? 10 a.m. Eastern time, the next stop for this market. The opening bell about 34 minutes away. Equity futures positive 0.2% from New York. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.